First step on its journey to return people to the moon. By the end of the decade, the uncrewed Artemis 1 rocket is set to lift off from the Kennedy Space Center. It's scheduled to circle the moon in an orbit that will take it deeper into space and then return to Earth 42 days later. The launch time is set for 8:33 a.m. New York time. And on Tuesday, we'll hear from New York Fed President John Williams and Richmond Fed President Thomas Barkin. On Wednesday, the Eurozone reports inflation data for August, plus more Fed speak from Cleveland Fed's Loretta Mester and Atlanta Fed's Raphael Bostic. And we'll get a slew of global PMI data on Thursday. And Friday brings us the U.S. jobs report for August. Matt, a lot to keep an eye on this week.
I mean, you know, no one has been to the moon, not just in your lifetime, but in my lifetime, no Americans have been to the moon, which I think is just insane. So very cool to hear that they're preparing to head back there. Let's get back to markets, still reeling after the top central banker delivered a hawkish message in Jackson Hole. Jerome Powell doubled down on the need to curb inflation, declaring that price pressures are here to stay and they will require forceful action to turn around.
Restoring price stability will likely require maintaining a restrictive policy stance for some time. The historical record cautions strongly against prematurely loosening policy.
Bloomberg's Michelle Jamrisco joins us now. Michelle, this speech, was it different, do you think, from the tone that we've heard from Powell in his previous speeches or Q&A sessions after decisions? And did it convince markets finally?
Well, it was different in length, Matt. I mean, it was much shorter at 10 minutes. It was much shorter than what we hear on Fed decision days. It was much shorter than previous Jackson Hole speeches, and it left very little room for varied interpretations here. He was undeniably hawkish in tone, as we had predicted. He drew on the historical context. I thought it was interesting that Powell mentioned Paul Volcker twice, talked about, you know, not going down the path of deviating from what Paul Volcker did, and just pushing harder on that inflation fight. So very little for doves here. He prioritized inflation again over growth very clearly, and he talked about the growth risks, you know, giving the harsh reality on the growth outlook, saying we're going to be in for a sustained period of below-trend growth, and there will be some pain for businesses and households. Powell was short and direct, and that's what he said he would be at the top of the speech. What we saw from markets is that they heard the speech finally this time. Bad news was bad news. We saw equities slide. We saw the two-year Treasury yield shoot up to the highest since 2007, and investors fleeing to the dollar. So you have to think that Fed Chair Jerome Powell thinks, you know, it was a decent job well done in communicating with markets this time.
And he certainly was channeling Volcker, as you said. He mentioned keeping at it, the title of Volcker's memoir, which some people made a big deal of. Michelle, thank you very much. Bloomberg's Michelle Jamrisco. Let's stick with themes coming out of Jackson Hole. There are growing calls for the European Central Bank to raise interest rates by at least a half point next month. Governing Council member Olli Rehn told Bloomberg at Jackson Hole that the ECB must act forcefully.
The reality is that we have excessively high inflation globally. It's action time, and our mandate is price stability, and we will work accordingly.
Bloomberg's Lizzie Burden joins me on set here in London to think about how the conversation has developed over the weekend around the ECB. Good morning, Lizzie. What are your thoughts?
Well, we're going to get more inflation data this week from all the euro area countries. Germany is expected to be the only one where you actually see a rise. The rest, we're going to see a decline in the big four. The euro area composite expected to come down from that record high of 8.9%, although we are expecting a bounce back in September because of this heat wave pushing up agriculture prices, and also the Russia shut off of gas flows through the Nord Stream pipeline, pushing up energy prices. But in terms of how it affects the ECB, yes, we've had all these hawkish comments. Rehn, I think, said it was action time. You had Francois Villeroy saying that it's time to act now because otherwise we'll have to be unnecessarily brutal later. So I think they will look through the PMI data showing that there's a recession. Worst is yet to come, although they'll also have to consider how much high borrowing costs will affect places like Italy. So Bloomberg Economics base case is for 50 basis points at the next meeting, following up on the last one.
Bloomberg's Lizzie Burden, we thank you, as always, for breaking that down. Over to Washington, Senator Elizabeth Warren has taken aim at the Fed's plan to fight inflation. She told CNN yesterday she doesn't believe increasing interest rates can contain current inflationary pressures.
Do you know what's worse than high prices and a strong economy. It's high prices and millions of people out of work. I'm very worried that the Fed is going to tip this economy into recession.
Jack Fitzpatrick, Bloomberg government reporter, joins us now from D.C. for more. Jack, it's so interesting at a time when we're talking about the Federal Reserve really sticking to that message. You're starting to see a little bit of divergence in the thought from some of those congressional leaders. Walk us through some of the details.
Yeah, it's notable to see some pushback from Democrats. It's not super surprising to see it from somebody like Senator Warren. It's not coming from President Biden yet. We haven't even heard a huge, broad outcry from the progressive wing of the Democratic Party at this point. But it is notable for a vocal, high-profile Senate Democrat who's certainly vocal on monetary policy to start pushing back on this. And I think it belies a little bit of nervousness from Democrats in the political context here, despite a wave of pretty good news or improving news on the economic front. Some nervousness that maybe the economy is obviously not a strength heading toward the midterms. So the key will be, do you hear something from President Biden, more progressives,
Jack,
but this is a little bit of pushback.
Wouldn't that be extremely unusual? I mean, presidents don't openly criticize Fed policy.
Yes, it may be a little less unusual looking back to the Trump administration, where it wasn't necessarily open criticism, but some frustration that was aired out more than the Biden administration. It would be very unusual for the president to do this. It does still seem that the president takes a significantly different tone than someone like Senator Warren. When the president has been asked about inflation, he's mentioned some things they've tried to do, but reiterated a number of times that's up to the Fed. So there's not a divergence yet in the mainstream Democratic leadership's line of that's up to the Fed, though that's not to say that it's not notable when you hear from somebody like Senator Warren pushing back fairly aggressively on this.
Jack, thanks very much. Jack Fitzpatrick of Bloomberg Government with an update there. Sticking with inflation themes, China is enforcing lockdown restrictions in areas around Beijing more intensively and plans to mass test the nearby port city of Tianjin. The moves come even as China's latest wave shows signs of easing. We'll get to that inflation theme in a moment, but let's stick with the COVID theme for now. Enda Curran, our chief Asia economics correspondent, joins us with the latest. Tell us, I mean, this is a continuation of existing policy, is it, Enda, or a doubling down on policy ahead of an important meeting?
It's just another day of more mass testing and more restrictions, and we had in the state press in China today reinforcing how nobody can lie flat in the battle against COVID. They've got to enforce the government policies, and like you mentioned, we're seeing evidence of that again with another round of mass testing in Tianjin, not far from Beijing, and south in Shenzhen, just beside Hong Kong here. They've put under lockdown an area that includes the world's biggest electricity wholesale market, so that's creeping into the industrial sector as well. It does reinforce that China is not pivoting away from its COVID zero strategy anytime soon. Like I mentioned, the state media doubling down on it, and it does appear as though they want to keep those cases very low now in the build-up to the Congress later this year.
I thought it was pretty interesting, Enda, to see Fortescue getting hit so hard on the bottom line from a drop in commodities prices because of less demand in China. Your big take story today, you wrote the big take, is on global inflation. Are we seeing a shift? Have we reached a precipice? Are we coming down?
So it's a nuanced story. Some economists are saying, look at what's happening in the commodities market. Oil prices have come off their highs. Some key commodities like copper, for example, you mentioned maybe iron ore taking a hit. And of course, food prices came off in July. So they're saying we might be at a turning point when it comes to headline inflation. But of course, then you get into the big debate over, well, how soon will it be before prices come all the way back down to where central banks want them to be, back down to their targets around 2 or 3%. And the feeling there is, well, that's a whole different story. We may or may not be at a turning point for peak inflation, but the global price shock is far from over. And that's why central banks have to keep raising borrowing costs the way they are. And that was a message from Jackson Hole that we heard over the weekend as well. Central banks have a lot more work to do.
Bloomberg's Enda Curran, we thank you as always. You can read Enda and Rich Miller's Big Take on Bloomberg.com or by typing NI Big Take into your Bloomberg terminal. Let's take a quick look at some of the stocks moving in pre-market trading in the United States, and we kick it off with Apple shares in particular. Remember, Apple's that big tech proxy. It's also somewhat of a consumer proxy for the S&P 500. It is down in pre-market trading, down 1.3%. Part of that is going to be the rate story, that hangover we were talking about from Jackson Hole, from Chairman Powell's comments. Well, some of that's going to hit tech shares the hardest. The other part is, of course, Apple's exposure to China, which may soon be changing if indeed those production plans to India go through. But still, the China story certainly weighing on those shares as well. Let's talk about another retail bane. Bed Bath & Beyond is going to be a big one. Those shares are actually higher on the day, 1.9% in the face of a risk-off market. This is going to be crucial when it comes to participation in the market. To create that bull case, you want the retail investors on your side. And right now, it looks like they're not really choosing the macro picture. They're just choosing their favorite name. So Bed Bath & Beyond shares up just shy of 2%. We'll end here with that risk sentiment indicator, or at least the carry-on through into the stock market. Riot Blockchain is perhaps a proxy for crypto-related stocks broadly. Crypto down actually today in line with the broader risk story. Well, today it is really taking it on the chin when it comes to Riot Blockchain shares, down 4.4%, Anna.
Yeah, weighing on tech stocks here in Europe, weighing on anything to do with crypto globally. Certainly something to watch as we go through the start of this week, then post-Jackson Hole. Coming up on the program, Dennis will be joining us. Dennis Boucher, who is the President and Chief Market Strategist at 22V Research. We'll get his perspective on Jackson Hole. How much of a surprise was it? What do we make of the market moves off the back of it? The level of hawkishness we heard from the Fed. And Goldman says it's time to buy commodities. We will be getting the take of another commodities expert. Ollie Hansen joins us, Head of Commodity Strategy at Saxo Bank. This is Bloomberg.
China's appetite for energy is enormous. The country consumes about a quarter of the world's energy supply, 35% more than the US annually. Its energy needs have more than tripled since the year 2000. That consumption has helped to fuel astonishing growth, but it's come at a cost.
China is the world's largest greenhouse gas emitter. There is no way to tackle climate change unless China reduces its emissions to net zero.
The country's reliance on fossil fuels is also a hindrance to its own growth and the well-being of its citizens.
China is not energy secure. It has a massive import bill for things like oil and gas. It has a long-standing pollution problem, and it is also prone to outages that severely hamper industry.
All this has led the world's biggest polluter to take steps towards a radical transformation.
Welcome to the world of decentralized finance.
I'm going to take a look right here at regulation.
We are seeing digital currencies under some pressure.
Bloomberg's covering all things crypto. The people.
I want to have some of my money outside of the sovereign.
The transactions.
It all comes down to the details here.
And the technology.
How does that affect disruptors like you?
What happens to everything that you're investing in when the last Bitcoin is mined?
Bloomberg Crypto, Tuesdays.
Welcome back to Bloomberg Surveillance. This is the early edition. I'm Matt Miller with Kriti Gupta here in New York. Anna Edwards with us out of London. We're all very focused on the dollar after Jerome Powell's speech at Jackson Hole and really the entire event, pushing up the greenback, giving it some real strength against, well, everybody, but especially the pound and the euro, or at least that's where we're focused with the euro under parity right now. Phil Serafino joins us, senior markets editor from Bloomberg out of Paris. And Phil, it's really interesting to see this Fed push. Is the ECB going to come along with it? Will they be pulled along with the Fed?
Yeah, I mean, I think they have to play a little bit of catch up here. There's a sense that the ECB is a couple steps behind the Fed. But I think, you know, Powell and the Fed have more of an incentive to keep going right now. Things, you know, the U.S. situation with inflation is such that they want to be absolutely sure that they get it under control. And so, yeah, the ECB is going to have to move in lockstep with them.
And if we look at US futures, Phil, we see NASDAQ futures down more than the rest, down by 1.2%. Tech stocks under pressure here in Europe. This is going to be a theme we return to, I suppose, as we fully appreciate the reiteration of this hawkish stance from the Fed.
Absolutely. You know, if you look back at the rally from mid-June to mid-August, tech was leading the way, and it was a bit of a head scratcher, hard to understand given that rates were going up, the economy's probably getting weaker, and but people were just assuming the best possible outcome. The Fed was going to get it just right. They were going to raise rates enough to bring inflation under control but not hurt the economy, and then they would stop. And Powell came out and said that's just not what's going to happen. And so tech stocks are leading the way down. I know they were the worst performers in the U.S. on Friday. In Europe this morning, they're leading declines along with consumer stocks, luxury goods, things like that. And as you say, the NASDAQ futures are down. So the market is sending a very clear signal that economically sensitive stocks, stocks that benefited from low rates, those are the ones that are taking it on the chin. It's hard to see what changes that in the short term.
Phil, thanks so much. Bloomberg's Phil Serafino. If you want further market analysis, check out MLIV Go. That is the function to use on your Bloomberg terminal if you want to find the market's live blog. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
In a $7 trillion industry, there's a lot of ground to cover.
Prepare for an economic hurricane.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. A lot's happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights
We think that's the next secular shift.
from businesses most influential and instrumental.
Yes, it's about renewables.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
Now, keeping you up to date with news from around the world, here's the first word. Credit Suisse is reviewing the long-term plans for its business in mainland China. It's part of a broader strategy revamp after the lender racked up billions of dollars in losses. Bloomberg has learned that Credit Suisse executives are meeting in Singapore next week to discuss topics including their view on the China business. And another Morgan Stanley banker has been put on leave in the wake of that U.S. investigation into block trades. Bloomberg has learned that Charles Leisure was part of a team that handled the big stock trades that have come under scrutiny. His boss was put on leave 9 months ago. The probe is examining how Wall Street works with buyers to carry out stock sales big enough to move prices. Coming up, Dennis Deboucher, President and Chief Market Strategist at 22V Research, on whether this market rally is truly dead. This is Bloomberg.
Apple has identified its next big business, bringing advertisements to more parts of your iPhone. Today, Apple pushes ads in 3 places: the App Store, Apple News, and the Stocks app. In the News and Stocks apps, Apple shows display advertisements. That means that third-party companies like car dealerships or mortgage lenders can showcase their advertisements just like they can on a website. On the App Store, the situation is different. There, Apple has search ads. This allows developers to buy their way into showing up higher on search results. For instance, an App Store developer can bid for the term car racing or basketball so their apps would surface above competing apps in the list of results. Apple's push into ads is a little ironic, given that its ATT, or App Tracking Transparency Privacy feature, limits the ability for Meta, Snap, and even smaller developers to generate as much revenue as possible from advertising. That's because the feature allows users to choose if they want their data collected and tracked across third-party apps and websites. Still, Apple's hoping to expand its own ads business and is planning to add search ads to its Maps app. Other areas where ads could eventually appear are on Apple Books and Apple Podcasts, along, maybe one day, with an ad-supported tier of Apple TV Plus to compete with new offerings from Netflix and other streaming video providers. I'm Mark Gurman. This is Power On.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Hawks have the upper hand. Global stocks hit a one-month low after central bankers delivered the message that they'll keep raising interest rates to fight inflation. China's stepping up its already tough COVID restrictions. Beijing's trying to wipe out the virus before a key meeting of Communist Party leaders. And Goldman Sachs urges investors to buy commodities now, worry about recession later. The bank says that outside of Europe, the risks of a contraction are relatively low. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kriti Gupta in New York. Kaylee Lyons is off today. And Matt, we'll have lots to talk about when it comes to commodities in the next part of the program. We're getting to that conversation shortly. But in the short term, market's still reeling. Another day of reeling, I suppose, from what we heard from Jackson Hole, because it wasn't just the Fed. Over the weekend, we got further hawkish commentary coming through from ECB officials.
Right, that's the European Central Bank for those Americans waking up early and checking out the program. I will walk you through a number of asset classes because there's a lot to talk about wherever you look. Equities obviously had an incredibly difficult day on Friday. The S&P 500 down almost 4% in its biggest drop since June, and that was before Jerome Powell came out nailing down his hawkishness and telling the market he won't blink in the face of inflation. Now, S&P futures are off only about 1%, a little less than 1% this morning, but you could see that really develop. I haven't got the Treasuries trade on here because it's a bank holiday. Anna has heroically come into work nonetheless. So there's no Treasury trading in the UK right now. Won't start here in the US until 8 o'clock. But we did have Treasury trading in Asia. It's now closed. And you saw the 10-year go up to 3.11. So a massive jump from the 3% that we saw on at Friday's close to where I guess it's going to open at 3.11 at 8 o'clock here. So watch Treasuries when they pop open. I do have the Bloomberg Dollar Index up. Real strength, 1297. So we're getting close to an all-time high for dollar strength, and you can see that reflected in all currencies, but definitely watch the pound and the euro if you're over in Europe. NYMEX crude is coming up a little bit, a little over 1%, a little over $1 to 94.10 right now. The commodity story is very interesting. As Anna was saying, Goldman Sachs says buy commodities, don't worry about a contraction in other developed economies because the chances are relatively low compared to Europe. Now the question is, what does that mean relative, right? And then Bitcoin right now down about 0.75%. Or $146. This is interesting because it's under 20,000 again. So once again, crossing back down as it looked like Bitcoin was having a rally. I guess the same is true with everything. Last week just brought us down, and now we're below a key level. Kriti, what do you see in terms of the pre-market movers for the U.S.?
Well, at the end of the day, Matt, it's a macro story, and that's really why I like to look at Apple, because not only does it have that China exposure, but the COVID story really going to be pressuring the likes of Apple and other tech suppliers, or tech makers, I should say, that have that supply chain going into China. But then you also have the rate story, the Jackson Hole part. You mentioned looking for treasuries. Well, of course, that impact, whatever we see as we start to see a little bit more volume in the treasury market, well, that's going to have an immediate read-through into the likes of Apple, Microsoft, et cetera. But for now, Apple shares are down to the tune of 1.4%. Very, very stark difference when you're looking at a retail favorite like Bed Bath & Beyond, for example. It is up 2.2% in the face of a risk-off market. Once again, it shows you just some of the power some of these retail traders have, even as you see volume really not working on their side. And I should also mention, you talked about Bitcoin dropping below that 20,000 level. Well, it's magnifying the effect when it comes to some of the miners, right? Blockchain down 4%, Anna.
Kriti, this is the picture across Europe then. Matt was talking about how we've got weakness in S&P futures once again, so looking to go lower there in the US. Well, the European stock picture is weaker. We're down by just over 1%. Technology stocks, as we discussed earlier, one of the areas of weakness. And one of the themes coming through from Jackson Hole was this higher rate environment then, and the German 10-year yield giving us an illustration of what that means here in Europe. I could have picked the 2-year. We saw a move higher in yields at the 2-year horizon as well, and I could have picked France or Italy. We saw those yields going higher across Europe, really, but over 1.5%, which is the reason I put in the German 10-year, because that's where we are right now, up by 12 basis points on that yield. This is the natural gas picture, and I've actually got better news when it comes to inflation and keeping an eye on the drivers, the energy prices, the drivers of inflation here in Europe. This is better news really coming through from Germany today. The natural gas price for the whole of Europe, this is the benchmark, down by nearly 17% in today's session. It was up last week by 40%, so that's the backstory that we need to keep in mind. This is not low levels, but it's not 340 euros per megawatt hour, now down to 282. So if storage is going to be running ahead of where some people had feared in Germany, then that is going to add to some of the downside moves on the gas price, and that is a good thing. We're also seeing, actually, German power prices more generally weaker, and this was different earlier on today. It jumped up to 1,000 euros per megawatt hour, but now down at 900, so down by 8.6% compared to the previous close, Matt.
All right, so a lot going on in Europe as well as here in the U.S. Joining us to talk about all of it is Dennis DeBoucher, President and Chief Market Strategist at 22V Research. Dennis, let me first get your take on the Fed. Mr. Market didn't believe Jerome Powell. Last week, it seems Jackson Hole was convincing enough to bring us back down. Do you see these routes continuing? How long until all of the Fed hawkishness is priced in?
Yeah, it's a good question. I think, at 3,800, I think it's difficult to be too negative on the market. Around those levels, you probably need a deep recession or probably a deep recession to be more or less high odds. And so I think it's difficult to see a market below 3,800. And of course, the market is part of financial conditions, right? So one of the mechanisms in which the Fed does its job of slowing the economy is through the financial conditions channel. So I'm assuming around that 3,800 level on the S&P, you'll have credit spreads that are a little bit wider. Obviously, you're seeing the move in Treasury yields. They'll be higher. So in aggregate, financial conditions will likely have tightened enough. And hopefully, economic growth will have slowed more. And when I say economic growth, I'm talking about the labor market and underlying demand, because there is downside risk to 3,800 if, in fact, we see some tightening of financial conditions and demand growth remains too strong. And when I say demand growth, I'm not talking about GDP. I'm talking about this underlying consumption and investment, all of which ties into tight labor markets.
So with the stock moves we've seen, maybe financial conditions tightening a little bit then, do you think, Dennis, that we learned a lot about how sticky Fed policy is going to be? So when we get to these higher interest rate levels that we're heading towards, how long we stay there? Was that one of your takeaways from the weekend?
I think that was the main takeaway. It's a great question. The subtext, and I shouldn't even say the subtext, but what Powell and the Fed have been saying for a while is that they have a single mandate, that mandate being inflation. Secondary to that was the economy. It seemed to me that investors maybe didn't believe that the Fed would let the economy weaken. And so what Powell did, and he talked about pain, and it's been very well covered in his Jackson Hole speech, was reinforce very sharply that the Fed is willing to accept a significant slowdown in the economy to accomplish its goal. And one of the ways that they're, having that translate into policy is not necessarily changing the odds of 50 versus 75 in September, but promising to essentially keep rates higher for longer. So yes, that is the main takeaway, is that they're going to take more economic risk. They're going to be willing to take on recession risk to reduce inflation. And that means that rates have to stay higher for longer. And that's what's essentially been priced over the last month, is a Fed funds rate that peaks around 3.7 and kind of stays around that level for a much longer period of time.
Okay, so he was talking about restrictive policy stance for some time, and as you mentioned, he did talk about pain. He talks about pain for business and pain for households that might follow from that. So what are the key data points for you then, Dennis? If the Fed has set its course and we know what their focus is, but at some point that focus will change, which will be the data points that will tell us when that change comes?
Great question. It's labor market data, so payroll is obviously a big one. CPI is still important, and obviously you have to focus on it, but I'm much more focused on labor market data and anything to do with consumer spending, particularly on services. We know that the service economy has been unusually strong over the last 3 to 4 months on reopening impacts. People didn't have a chance to travel or dine out or whatever over the last 2 years, so you've seen extremely strong service growth. That's where most of the labor is in the U.S. economy. That's why labor markets are very tight, because of a strong service economy. So we're going to have to see service growth slow come September, which a lot of people think will happen as spending normalizes, and the labor market data needs to loosen up. Those are the two main things. So I would just put it this way to you: if we're going to print 300,000 on payroll this Friday, which I believe is the latest estimates on Bloomberg, that's probably going to be too strong in the context of the 500,000 plus we just had last month.
So how does that translate to the actual market action? If we start to see unemployment actually increase and really loosen some of the labor market to some extent, is that going to be interpreted as a positive for the markets, even if it is a positive for the economy?
Yes. I mean, the unemployment rate drifting higher would likely be a positive for the market, assuming it doesn't move too quickly. So obviously you see what I'm doing here. We got to thread this needle. I mean, that's the unfortunate truth. So to see a breakout above the 4,200 range, you're going to have to see the unemployment rate drift higher call to the 3.8, 3.9 range and inflation come down fairly aggressively towards the Fed's target, getting to around 3% or just below on core PCE by 1 or 2Q of next year. And those are the type of data points you'll need to see for the market to be comfortable that the economy's slowing, but not too aggressively. The Fed has inflation under control, and that the Fed doesn't need to tighten policy anymore. And then you could have the chance for equities to move, higher. But if you don't see that, if you see the unemployment rate go to 4.2% in a couple of months, that's obviously going to be bad for the S&P. So, we need data to soften, just not very quickly.
Dennis, I'd love to know how you're positioned right now. I mean, you're running a research firm. Before that, you were running portfolio strategy and quant research at ISI, and you're consistently ranked one of the top portfolio strategists in institutional investors. So I don't know your risk profile, but how are you positioned right now?
So neutral on the market. Again, I think it's a 3,800 to 4,200 range. I think over the next month and a half, there's downside, right? So we'd probably be closer to 3,800 by the end of September. There's a lot of reasons for that. Mainly one is the acceleration of QT in September, obviously a hawkish Fed, and probably some slowing of economic growth all at the same time, which probably leads you to some downside risk near term. That also leads us to be defensive. So low volatility factors for sure. Staples, utilities, REITs at the expense of cyclicals. So, and the growth factor over the next month or so probably coming under a little pressure. When I say growth, I mean the more speculative portions of growth, like the ARC funds, not your high quality defensive growth, which probably does a little bit better. So more or less defensively positioned.
Defensively positioned. Thanks, Dennis. Thanks very much for joining us. Dennis Duboucher of 22V Research. Coming up on the program, we'll talk commodities. Goldman says it's time to buy commodities. We'll get the take from Ole Hansen, Saxo Bank Head of Commodity Strategy. This is Bloomberg.
Stronger that moment that you're lifting the barbell. You get stronger as your body is making repairs, making recovery. Recovery is a when and how you get fitter, faster, stronger.
Recovery technology includes everything from massage guns and foam rollers to compression boots, hyperbaric chambers, cryo chambers, infrared saunas, and even infrared pajamas. And athletes are partnering to become investors to take those products mainstream.
When you look at tech in sports right now, it's completely innovating the way training's going, completely changing the way recovery's going. I think sky's the limit as far as where it can go.
But while some of these products can feel amazing, it can be difficult to differentiate between what really helps the body and what just tricks the mind.
Every time you're chasing the latest, greatest, newest tool, you're probably chasing a mirage.
No one covers the world like Bloomberg.
We have to get interest rates higher and bring inflation back to our targets.
Spare capacity is becoming scarce. We are running on thin ice.
No one deliberately wants to go into battle, but we sleepwalk into conflict.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Kriti Gupta here in New York and Anna Edwards out in London. Now, Goldman Sachs is urging investors to pile into commodities. They say most recession risks are overblown in the near term and that raw materials stand to rebound amid the energy crisis and tight physical fundamentals. Joining us now is Ola Hansen. He is head of commodity strategy at Saxo Bank, coming to us out of Copenhagen. Ola, thanks so much for your time this morning. Let me ask first what you think about this call. You know, Goldman is saying that a recession is not necessarily in the cards for developed economies outside of Europe. Nonetheless, China seems to be a real weak spot, as we saw evidenced in Fortescue's profit or drop in profit today.
Good morning, Matt. I think the call for commodities is correct from Goldman's. Obviously, right now the market has been focusing very much on the growth and the recession risk during the summer months. But I think that we've seen a change in the sentiment during the past month, where the market has once again, especially for I would say the food commodity part and the energy part, has returned their focus to the supply side, and it just highlights the fact that even though we may see a slowdown in growth, we could still see higher commodity prices because the supply side remains challenged as well. China is interesting because we've seen an attempt to, especially for industrial metals, to recover as well during the past few weeks. We saw the stimulus measures being added last week, adding some additional support. But obviously, as we head into this week, some of these metals have given back of some of the gains with the general dollar strength that we've seen after the meeting on Friday. Or the comments on Friday.
Yeah. Ola, good to speak to you. Why is it that commodity markets take those stimulus measures from the Chinese government so seriously when some other assets kind of shrug them off and say, well, if there's no change in the COVID policy, then this isn't going to touch the sides? Why do commodities take these stimulus moves much more seriously?
I think first of all, because we've seen in the past how aggressively they can act when they do start to react, and if anything, this slowdown they've seen definitely calls for some kind of response, and I think that's why we're getting this renewed demand coming in or expectation for demand. But at the same time, the high energy prices are cutting supplies. We've seen the reduction in smelter capacity in Europe, zinc, aluminium. So the supply side is challenged as well. We saw Codelco last week announcing that they're struggling to meet their own targets in terms of production. And then we have the whole green transformation, which I know we've been talking about it for a long time, and the impact on metal demand has really yet to show up. But if that is serious, meant to be serious, then we will see that the underlying demand provides support for the industrial metals over the coming years, a support that otherwise normally is being provided by China.
So what does that mean in terms of volume that's being traded? Are you starting to see more and more people actually active in the market, or is open interest perhaps collapsing because of how volatile the market is? How does it work in terms of the market plumbing?
Well, the market is struggling to build up open interest after the initial surge in prices back in March around the start of the war in Ukraine, because higher volatility means lower exposure because of for those targeting volatility. And since then, it has come down still. I sense a certain plateau starting to emerge here, but obviously we need to get out of the summer period as well. A lot of positions were reduced ahead of the summer period, the holiday season, and we may start to see that come back. But at the same time, if you look at some of the contracts, for instance, in Europe, we saw the gas correction today. But if you look at the margin just to hold a gas position or a power position in Germany, is just unreal, and that basically means that it's a market increasingly left to a few actors, which basically means as well that volatility is as high as it is right now.
That's really interesting, Ola. I was going to ask you about gas prices here in Europe, because we see, the continental European benchmark down by 18.5% today. Of course, last week it was up by 40%, so that's the level of volatility we're talking about here. How positive is it, though, that Germany has managed to get to levels of storage that perhaps had seemed in doubt a few months ago?
It's a good story, but it's also obviously coming at a very, very high price. But it still doesn't leave us out of the woods if we get a very cold winter, because even though we got storage at those levels, we still need to buy a substantial amount on a daily basis. And if that's not coming from Russia, we will be competing with Asia for LNG shipments. But the risk right now in the week ahead is really that we could be 100 euros higher or lower in a week's time, because the most recent surge has been driven by this maintenance announced on the Nord Stream 1 pipeline. I do believe that it will resume, but again, there's a lot of skepticism in the market, and we know that the energy is increasingly being used as a weapon to reduce the support in Europe. So we'll see, but I think flows will come up. Otherwise, they'll just have to flare even more gas. And we saw the reports last week that more than 4 million tons, cubic meters are being flared on a daily basis because it's not being sent to Europe.
Ola, thank you very much. Thanks for your thoughts. Thanks to Ola Hansen, Head of Commodity Strategy at Saxo Bank. Certainly a lot of moving parts when it comes to the energy story here in Europe. And later today, we will speak with Goldman Sachs Senior Commodity Strategist. So if you're interested in their commodities call about buying commodities now, thinking about recession later, then tune in. That's at 11:30 a.m. in New York, 4:30 p.m. in London. This is Bloomberg.
very transparent to the shopper before they accept an order, what the order is going to look like, how much we're going to pay them, and how much the consumer is paying them. And so they can decide whether they take an order or whether they refuse it. And that's the kind of flexibility that our shoppers really value and the kind of transparency that they want.
Are you seeing a labor shortage right now? And what are you doing to combat that?
It's different in different places. Our demographic of shoppers is completely different from food delivery and ride sharing. We're 70% women and half of them are moms. And that's because a lot of the job at Instacart is very different than just being in a car with strangers. It's about like going to the store, doing a good job of customer service, of really picking the right products for the consumer. And we are seeing that being very appealing to women.
Difference between political gossip and policy intelligence. Bloomberg Government provides our clients with expert reporting, analysis, and public affairs tools that give you the edge in reaching policymakers on the Hill. When you're in the business of influence in Washington, information and connections are the currencies on which you rely. For knowledge you can act upon, the difference is Bloomberg Government.
What is your base case for Italy in terms of what happens politically and then what the economic fallout is?
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Kriti Gupta here in New York. Anna Edwards with us out of London. And Tom Keene is back from leading our coverage out of Jackson Hole. Tom, rumor has it that you and John Farrow were deep into debate late into the night at the $1 Million Cowboy Bar as to the value of the Dow Jones Industrial Average. What did you come up with?
Then we went home, and in our dreams, we dreamt of jackrabbits all of Wyoming. Right now, what we're dreaming about is a stock market that can calm down the VIX out to 27.43. I'd really make note, and a major theme for John, Lisa, and I today, folks, is going to be the new record dollar strength. You hear me right? We're out to record dollar strength on BBDXY. But let's look at the equity market right now. It's not that bad. Yes, we're back in correction territory. A lot of complexity on this chart. All you need to know is the red bracket is a bear market. We're above that. The yellow bracket is a correction. We're below that on the Dow Jones Industrial Average. But to me, Matt, the real impatience for people is we are 17 months into the correction from where we last were at this level.
Interesting. And that's the sort of Jackson Hole hangover we're still dealing with then, Tom. Who do you have on the program to take us through some of the investment themes?
We're going to move forward on the investment themes and on the jobs report this Friday out of Jackson Hole. Winthin will get us framed out on foreign exchange with Brown Brothers Harriman, Ellen Wald on oil. And moments ago, I'm pleased to tell you we will bring a bull to you. John Stolfus of OPCO will reaffirm the long term in the equity markets.
Tom Keene, we thank you as always. Lots to digest in the hours ahead. Let's take a look at what we're watching. I'm watching the Offshore Northern Shore Conference, the ONS conference, it's otherwise known as, underway in Norway right now with addresses due from both Elon Musk and President Vladimir Zelensky of Ukraine. What does that actually mean, Matt, in terms of the future of energy?
Yeah, that's interesting. I think Zelensky is offering up more energy storage, and that's been a key issue in Germany and across Europe, of course. I'm watching something that will also apparently involve Europe. NASA is preparing an uncrewed rocket launch as its first step to get back to the moon by 2030. Now, as my boss's boss writes in to point out, only Americans thus far have ever been on the surface of the moon, as far as we know. And this time will be different because, Anna, are we bringing Europeans with us?
There is a role for the European Space Agency. I know that. We're watching live pictures there. We'll certainly bring you the latest on that NASA launch later. Going back to what Critty says, I'm watching the energy story here in Europe. Quite incredible that we have European gas futures down by 17.3% today. Those power prices in Germany also coming off very recent highs over 1,000. This is Bloomberg.
We anticipate that you will have regulations clarifying what the SEC is going to do on cryptocurrencies and related kinds of things in the near future.
It's pretty clear that many of these tokens may be securities. What we've asked the trading platforms, the lending platforms, the other various venues to come in, to work with us, to get registered under the securities laws, because if a platform has 50 or some of them 500 tokens on their platform, probabilities are they're not all non-securities.
Now, there's another issue that has arisen, which is called gamification, which is to say people are making a game out of trying to buy stocks. Are you worried about this phenomenon?
We live in the 2020s in a new digital age where applications on our phones can use massive amount of data and then predict our behavior. What do we do when the digital algorithms are maximizing for the company's revenues rather than our returns? And so we're trying to think that through. It's not just gamification, it's a little bit more than that. It's whether there's a conflict between the app and our investment returns.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Getting inflation down to 4% is not getting the job done.
They're going to knock down inflation. It's going to be painful, but they're going to get it down.
The inflationary pressures, both demand and supply, are leading to these bigger problems.
Maybe inflation is peaking, but it still remains way too high.
What I'm concerned about is that on the current regime, the central banks are set up to fail.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
The Jackson Hole fallout continues, live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Futures down 9/10 on the S&P. TK, an 8-minute speech sparks a $1 trillion market rout.
The shock when we realized how short the speech was, sitting there, and Mike McKee saved me. He said, I think it's going to end soon. And I'm like, really? And there it was. We were making jokes, John. I believe it was Wednesday evening with President George about Pivot the dog, which is her new puppy at the Kansas City Fed. John, this was one giant anti-pivot, and it continues this morning.
And that's exactly what Evercore are calling it, Tom. One priority, get inflation down. And if we're willing to accept a recession, they're willing to accept a recession. Tom, not just the Federal Reserve, also the ECB over the weekend. I think Isabel Schabel of the ECB with this quote right here. Even if we enter a recession, we have basically little choice than to continue our normalization path. That's the effort, Tom, from the Fed and the ECB.
We stopped the show now for all Americans on radio and TV that Ferro is not demanding that we look at the ECB. The fact is we must all look at the ECB. And, John, you see it with pound sterling well under 117. Pound sterling on my moving average basis is at post-Brexit weakness this morning.
And euro dollar just about holding on. Lisa, we need to talk about the prospect of QT, perhaps a move as big as 75 basis points on September 8th, and this bond market in Europe breaking down a bit again.
And the lack of predictability in this Fed meeting, there was a paper that was presented talking about the unwind of the balance sheet and how it could potentially lead to a lack of liquidity that was really concerning to the likes of Rajam Ragan of formerly the Central Bank of India. How do you sort of game out how this is going to play out at a time when central bankers globally, not just the Federal Reserve, are willing to accept the pain that it inflicts, because inflation was the one word that Jay Powell mentioned 45 times in an 8-minute speech. 45 times.
Really? You know who won't accept the pain? The politicians. Yeah. Did you get a glimpse of that over the weekend again from Senator Warren to CNN? This was the quote, Lisa. I am very worried that the Fed is going to tip this economy into recession.
We've been waiting for this, right? I mean, basically, this is the normal game plan, is that the Fed tightens, worries of recession build, politicians push back. This time, she is so alone. Who else is with her coming out and talking about that? I don't hear a lot of anti-hawks. Even as they say, perhaps you don't want to kill off the economic momentum, they still are reiterating inflation, inflation, inflation. In fact,
TK
45 times.
said it a few times, Lisa, and I appreciate the 45 times. I'm pleased you counted. I didn't. So, TK, you've waited for this moment where the politicians start to lean the other way. Is this the beginning of that?
Well, we'll have to see, and all of it folds into the election as well. What I would say, and this was a theme at Jackson Hole Unspoken, John overheard this in conversations where he was pretending to be a waiter at the famous Blue Heron bar. John, it's also about weak Asia and a current schedule to join us. In the ECB focus we're going to have to September 8th, Chairman Powell's getting no help on growth abroad.
Not at all.
and he might get a little bit of help, Tom, by the BOJ, and we can discuss that a little bit later. Futures on the S&P 500 down 0.9%. On the S&P on the Nasdaq 100, we're down by more than 1%. The sell-off continues. Let's talk about the bond market. Yields up 7 or 8 basis points, 3.12% on a 10-year. Your 2-year, through the highs of the year, back to the highest levels we've seen, going all the way back to 2007. And the dollar, the strongest we've seen, Lisa, going all the way back to 2002. So cross-asset, there are some big things developing in the last couple of days.
The dollar is one of the biggest stories, and how potentially disruptive this is at a time when it is the only flight to safety that you see on a consistent basis. Yes, you could talk about the euro Swissy, and I'm sure we'll talk about that significantly. However, this really is a massive and potentially disruptive story. Today, it's a light day ahead of a very big week of economic data in the United States. Today, Fed Vice Chair Lael Brainerd, one of the Troika, will follow up what we heard over the weekend, delivering pre-recorded remarks at a Fed Now workshop in Chicago. I want to hear about the balance sheet. We did not hear about the balance sheet in that 8-minute speech from Fed Chair Jay Powell, and yet there is this concern about what the effects, what the ramifications are of shrinking a balance sheet that has mostly only grown. It has not really contracted over the past few decades. The concern is it could remove liquidity from a market that already is trading at volatility levels that we have not seen for decades. I'm not talking about the VIX, I'm talking about other measures. Today, also, German Chancellor Olaf Scholz traveling to Prague to speak with the Czech Prime Minister, talking about the energy crisis. You are seeing natural gas prices in the Euro region fall off a little bit today. Not so much German power costs. It is a controversial measurement, but still, the chart is shocking. It is exponential. This looks like something that you would see in a parabolic kind of function in your math class. And at 10:30 a.m., we get U.S. Dallas Fed manufacturing activity for August. And I mean, we could be saying that it's Dallas manufacturing Monday, but really this issue is it's before the ISM manufacturing report on Thursday, which actually, John, is important. It is something you have picked up on, especially after the really dreadful manufacturing numbers that we've gotten recently, that people just shrugged off as not that significant.
Lisa, I don't think Dallas Fed manufacturing Monday is going to catch on.
Just not too catchy.
Just going to throw that out.
Well, I mean, we could try. I mean, every data point's important.
I'm not coming along for the ride with you. Lisa, I have to say, how much nicer is it, Tom, back in the studio? Warmer?
Oh, yeah.
Isn't this nice?
It's only 50 degrees here. You know, folks, you should have seen it. Abramowitz starts in at the Blue Heron Bar in Jackson Hole with the Nerd Fest you just heard in the morning brief. John, the bar came to a complete halt.
As soon as Lisa
there
walked
was just
in.
silence.
Yeah, everyone's
she
like,
started
please.
it on parabola, x squared plus y squared equals 1 or something, and she says, look at the unit circle. And I mean, it just was a complete
I think you're describing yourself and not Lisa. Win Finn joining us now, Global Head of Currency Strategy at Brown Brothers Harriman. Win, let's start here. What changed for you over the weekend?
In a word, nothing. The only surprise to me was how surprised the markets were. I mean, this was a culmination of an aggressive, coordinated, well-orchestrated communication effort by the Fed. And they've been saying this for the last 2 weeks. We are keeping on this hiking path. We may see a recession, we may not, we hope not, but we're hiking. And Mr. Powell really just pretty much summarized that whole message in, as you point out, 8 minutes with many mentions of the word inflation. And I think it's been consistent. I think it's the right message. It's probably not the message the equity markets wanted to hear, but that's the right message at this point.
When what we have seen in the last 24 hours is a reaffirmation of strong dollar. There's any number of ways to measure this, but with your decades of work, the Bloomberg Dollar Index really captures EM. BBDXY is out to record strength this morning. What does that symbolize?
Well, it does symbolize that emerging markets will remain under pressure. I've been sounding like a broken record, and I apologize, but we have global tightening, weaker global growth. That is not the environment for emerging markets and other risk-type assets. But in particular, emerging markets, look, they can see some pockets of strength. Some of the commodity exporters have been doing well, but we've seen really a flight to quality. There's been massive outflows from EM. We saw a little bit of inflows in August, raised some hopes, but that was really, I think, a head fake. It's hard to say, yes, load up on EM right now. Eventually, when we get near the end or towards the end of the Fed tightening cycle, maybe we see some stabilization economic data worldwide. We might see a slight bid for emerging markets, but I would stand out of the way right now.
And Lisa, are we on the 7 yuan per dollar watch? I think all of a sudden we are out of Beijing.
Perhaps, although Leland Miller does not think it's that significant, considering that this is not an issue for a lot of Chinese officials, that the strength of their currency is not what they're necessarily going to hold on to, given some of their other issues. When, as we look at the flight to quality, as we look at the dollar strength, at what point does it become profoundly and structurally disruptive disruptive, akin to what we saw in March of 2020, when the Fed was forced to step in a way where perhaps it will not this time?
Yeah, so we have to look at, I think, in sort of two spheres. Obviously, the dollar strengthening at the majors is undesirable for those countries like the Eurozone that are trying to fight inflation, because the weaker currency feeds into inflation. But in general, you don't look for crisis of any sort. Yes, they'll be under a lot of pain, recession, et cetera, but it's emerging market with the real pain points, right? That's where we talk about solvency issues, liquidity issues. So for every percentage point or 5 percentage point weakness in the currencies of emerging markets, it makes it that much more difficult for them to service external debt. The dollar issuers are safer because they have for instance, the commodity exporters have a dollar supply. But if you're a local currency issuer in, say, Brazil, and all of a sudden your revenues are the same, but your payments in dollars become 10% more expensive, you're coming under a lot of stress. So look, we've already seen this in a lot of countries, the frontier countries. They're sort of the canary in the coal mine. Sri Lanka, Pakistan, now we've got Egypt having problems, some other countries in Egypt. Is it a contagion? Well, I hesitate to use that just because the fact is that we're in this incredibly negative environment that's going to pressure the weaker links. I think the stronger links in the EM will ride this out, but the weaker links, especially in frontier markets, are really going to come under pressure. I don't think it's going to be systemic risk, but we will see more and more countries come under pressure and really face some really, really difficult times.
Within some difficult decisions to be taken this year, that's for sure, of Brown Brothers Harriman. Thank you, sir. Chairman Powell, for many people delivering the speech that they expected, the pushback for many people in the equity market, maybe the speech they were hoping he wouldn't deliver. Equities down by 0.9% on the S&P. Lisa, this line from Chairman Powell, estimates of longer run neutral are not a place to stop or pause. Was this the cleanup act for that news conference a few months ago?
So some people are coming out and being hypercritical of the fact that it was not a mea culpa. It wasn't necessarily a full-on repudiation of some of the errors of the Fed's past ways and past assumptions. However, yes, I mean, this is basically going exactly in opposition to what a lot of people got from the last meeting, including, we're going to hold them there for a long time, guys. We're not going back to lowering rates anytime soon. It was consistent. It was from every Fed official we spoke to and reiterated again from Fed Chair Jay Powell.
It's easy to shake off some of these comments, Tom. They will take on renewed importance when we start to get a labour market that looks like it's breaking down. Unemployment's at 3.5%. When we get to 4%, how can they convince people, the general public, that a higher unemployment rate is worth a price worth paying to get inflation down? That's where things start to get a little stickier for this Fed.
In terms of data dependency, two ideas. One is John Hilsenrath in the Journal this morning on global domestic income, and the other, John, is a non-farm payrolls coming out Friday. We migrate 285-ish out to a new 300,000 number. Wow.
Peter Chair's going to have thoughts on that of Academy Securities. He'll join us in about 50 minutes' time. Futures down 0.9%. The sell-off continues. Hello, Monday. Good morning. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. NASA is about to take the first step on its journey to return people to the moon by the end of the decade. The unscrewed Artemis 1 mission is set to lift off today from Kennedy Space Center. It's scheduled to circle the moon in an orbit that will take it deep into space and then return to Earth 42 days later. Earlier today, engineers were checking a leak affecting the hydrogen tanking process, which had already been delayed by bad weather. U.S. Navy warships have sailed through the Taiwan Strait for the first time since House Speaker Nancy Pelosi's visit to the island. That trip strained relations between the U.S. and China and led to Chinese military exercises around Taiwan. The Navy says its ships were demonstrating the U.S. commitment to a free and open Indo-Pacific. European Central Bank Governing Council member Martin Kazak says interest rates should be raised by at least a half point next month. Kazak is urging the ECB to show a resolute response to soaring inflation. The Eurozone releases its latest inflation data on Wednesday. And in the UK, the front-runner to become the next Prime Minister, Liz Truss, reportedly is considering slashing the country's value-added tax by as much as 5 percentage points. The Telegraph says that could head off criticism she doesn't have a plan to tackle the cost of living crisis. Credit Suisse is reviewing the long-term plans for its business in mainland China. It's part of a broader strategy revamp after the lender racked up billions of dollars in losses. Bloomberg's learned that Credit Suisse executives are meeting in Singapore next week to discuss topics including their view on the China business. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
To name a couple of your babies. I don't know if I'm asking you to choose amongst your children, but you know, some of the most recognizable buildings by you, of course, the Millennium Bridge, London City Hall, the Reichstag, and the Great Court British Museum. What was your favorite project to do?
The Reichstag does stand out because, first of all, it's an energy manifesto. So it transformed something that was dependent on fossil fuels. It uses all the technology to produce something which is essentially carbon neutral. And as a public building, that's a statement. It's a symbol of a city, it's a symbol of a nation. It incorporates works of art. It's recycling an existing building, which, as I mentioned earlier, is the ultimate in sustainability. If you can give a new life to a building, it also creates public space at the roof level. It is the most visited parliament in the world, so it puts the public above the politicians who are answerable to them. And that, of course, was made possible by the politicians. So it's a demonstration of democracy in action.
Welcome to the world of decentralized finance.
I'm going to take a look right here at regulation.
We are seeing digital currencies under some pressure.
Bloomberg's covering all things crypto. The people.
I want to have some of my money outside of the sovereign.
The transactions.
It all comes down to the details here.
And the technology.
How does that affect disruptors like you?
What happens to everything that you're investing in when the last Bitcoin is mined?
Bloomberg Crypto, Tuesdays. In a $7 trillion industry, there's a lot of ground to cover.
Prepare for an economic hurricane.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Friday.
Why has Elon Musk said no to the car factory?
It's still in discussion. Let's see later the final result.
Do you think that by bringing people together, that is a way to solve conflict?
There must be communication, even if it doesn't necessarily resolve the problem. It is better to have dialogue than to have open conflict.
This is a conversation with President Jokowi of Indonesia.
Only on Bloomberg.
Restoring price stability will likely require maintaining a restrictive policy stance for some time. The historical record cautions strongly against prematurely loosening policy.
Hello, 2023. Love Chairman Powell. Jerome Powell there, the Federal Reserve Chair in Jackson Hole going into the weekend, pushing back against anyone thinking you get rate cuts anytime soon. Futures down almost 1% on the S&P 500, on the Nasdaq down by more than 1% on the Nasdaq 100. Yields are higher by 7 basis points on a 10-year, 311.55 on a 10-year. Your 2-year through the highs of the year, very close to 350 a little bit earlier this morning on a 2-year maturity. The highest yield going all the way back to 2007. Levels we haven't seen since 2002 on the dollar index. Euro dollar just about holding on. 99.67. TK, a story that slipped under the radar last week was this one right here. A letter sent from Secretary Granholm to energy players in the United States of America concerned about low stockpiles of gasoline and diesel, historically low levels in the Northeast, and saying this to them, Tom: it is our hope that companies will proactively address the need. If that's not the case, the administration will need to consider additional federal requirements or other emergency measures. Tom, what do you make of that line and the prospect that maybe we start to think about curtailing, perhaps even banning, fuel exports?
I think the surveillance has been out front of this, John, and particularly with Stephen Shork of Philadelphia, who knows every valve in New York Harbor. John, it is a tangible issue, but you wonder if the Secretary of Energy consulted with the Secretary of State before that release.
Or even the White House and the President of the United States, Tom. This is going to get tricky when the Europeans, Tom, really face the crunch later this year.
Well, I'd say the crunch is here right now. That's one of our themes here as we look to the ECB. Again, for our American audience, we are truly focused on European affairs out to September 8th. It may seem a little distant from America. It's not. Right now, in the distance in Washington, Jack Fitzpatrick joins us, Bloomberg Government. Jack, I want to go to where President Biden is right now. It sounds to me like he should be taking a subtle set of victory laps now. Is he, or is he so beleaguered he can't enjoy the moment?
It seems like he is taking a bit of a victory lap, and Democrats heading toward the midterms are playing up their legislative victories, the fairly good economic news lately of gas prices going down a bit, and it does make sense for them to do that now, considering, you heard Senator Warren saying she's concerned about a potentially somewhat severe recession or millions of jobs lost down the road, depending on what the Fed does. So I think they're in the moment where they can take a bit of a victory lap because they've gotten a good chunk of what they've wanted to get done legislatively. They've had some fairly good news, but there's also a sense that there's potentially some bad news on the horizon, and Democrats are probably hoping that waits until after November.
The senator from Vermont, Patrick Leahy, flogging a book this morning. We're thrilled that the senator will join us here in the 8 o'clock hour. Give us an update on the strength of liberals, the strength of progressives within the party. I mean, they got the vice president and they got a victory lap with student loans. But what is the voice of liberals, like the senator from Vermont now, as we go into the election?
Senator Leahy's an interesting one. I think, one, big picture progressives, yes, they can be happy about what they got on student loans. They wanted more. They probably should be happy with what they got in the remnants of the Build Back Better agenda, because that was a significant bill despite it being pared down. Senator Leahy is in charge of appropriations in the Senate, and I don't know if there's any spending deal that on the horizon. They seem to be moving pretty slowly. They would need that to follow up on the measures in the CHIPS bill that they got, that is largely authorizing measures, and they need to fund it in order to make it fully accessible. So Senator Leahy in particular has a lot to do over the next few months that is a significant challenge that could follow up on some of their victories. But it's a mixed bag for progressives overall.
Jack, just quickly here, I want to finish up where John was beginning. This question about the domestic agenda and how that pairs with the international attempt to truly shore up friendships with alliances. How much is the U.S. going to double down on exports of natural gas to Europe ahead of this winter that is going to be very difficult in the face of the Russian invasion of Ukraine and some of the questions around the pipeline, the Nord Stream 1, that goes into maintenance later this week? How much is there a conviction in Washington of the importance of continuing these exports and continuing the support of Europe?
There is enough of a conviction so that story a couple days ago on the Department of Energy letter was pretty surprising. It does seem to be in a serious contrast to what the administration has talked about in the realm of foreign policy. There really does not appear to be a flagging in the support for measures that not only Ukraine aid measures, but energy aid measures to Europe in response to the invasion of Ukraine. So the Department of Energy letter might be an outlier, and if you talk to foreign policy people, lawmakers in Washington, it seems there's still a good amount of support for energy exports.
Jack, thank you, sir. Jack Fitzpatrick. Lisa, the big issue, as you know, is how do you balance the domestic economic tension with the foreign policy issues? And I think that captures it perfectly well.
Well, and we saw this when the Freeport LNG export facility in Texas went down because of some disruptions, and that is 1/5 of the exports to Europe. And we saw that actually lower natural gas prices in the U.S. And some people started saying, "Well, let's do this." And other people, Biden in particular, coming out and said, "Absolutely not. We need to support our allies." How much does this create a tension between his energy secretary and him?
Do you think the energy players are going to listen to Secretary Granholm anytime soon?
No. I mean, also, it's not clear that she has the power behind her of even bipartisan support or even partisan support from the Democratic Party. So why are they going to follow that? But that really goes to this sort of policy uncertainty that a lot of these energy players are feeling.
Let's get to the market uncertainty. Equities are down by 9/10 on the S&P. If you're just tuning in, the NASDAQ lower, Tom, by more than 1 full percentage point. If you listen to TK and you went to cash, probably happy you went to cash many times this year. Tom, yields higher on a 10-year, on a 2-year, on a nominal basis, and Lisa put out a great chart earlier this morning. Real yields this year, Tom. Brutal.
Yeah, real yields are there and they're breaking higher. John, by the time you get to the real yield, folks, look for it this Friday. You may break out to a new high, which I'm going to eyeball at 70 basis points back to 2018 above 1%. We're nowhere there yet, but the fact is the 10-year real yield on Friday moved.
We've got to catch up with Andrew Slimman of Morgan Stanley Investment Management.
Yes.
We'll do that in about 5 minutes' time. Equities really on the move once again, adding to the losses from Friday, waking up Monday, more of the same. On the NASDAQ 100, we're down by more than 1 full percentage point. On the S&P 500,
no, I don't want hot
down 9/10 of 1%.
I don't need clothes.
Ramo, I think London's got the right idea this morning.
Cinema.
Take the day off.
Yes, I would agree.
Take the day off. Take a long weekend.
Everyone.
From New York, this is Bloomberg.
China's appetite for energy is enormous. The country consumes about a quarter of the world's energy supply, 35% more than the US annually. Its energy needs have more than tripled since the year 2000. That consumption has helped to fuel astonishing growth, but it's come at a cost.
China is the world's largest greenhouse gas emitter. There is no way to tackle climate change unless China reduces its emissions to net zero.
The country's reliance on fossil fuels is also a hindrance to its own growth and the well-being of its citizens.
China is not energy secure. It has a massive import bill for things like oil and gas. It has a long-standing pollution problem, and it is also prone to outages that severely hamper industry.
All this has led the world's biggest polluter to take steps towards a radical transformation.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
It is the J. Powell route from New York City this morning. Good morning. It continues on the S&P 500. Futures lower by 0.9% on the Nasdaq 100, down by 1.15% after Friday's losses, the biggest one-day drop since the middle of June. Bear in mind that even after Friday, we're still 10 to 11 percentage points higher than the June 16th low. Meanwhile, the bond market has already taken out the June 14th high. On a 2-year, we do that this morning. Let's take a look at it. Earlier in the session, 348. Right now, through 345. That takes out the June high. We have to go all the way back to 2007 to see your 2-year right here at 345.79. So yields up on 2s, yields up on 10s by 7 or 8 basis points to, let's call it, about 312. And it's not just the US. Take a snapshot of Europe. In Italy, in Germany, yields higher. And it wasn't just the Fed that pushed back as well. It was the ECB too. Are we going to consider QT and a 75 basis point hike from this ECB on September 8th? You've got yields up in Italy, Tom, yields up in Germany, and for once, just a little bit of euro strength in the mix, 99.86.
John, the likelihood of the 75 beeps and the ECB not having an effect is about the likelihood of stopping a Harry Kane penalty shot. It's never going to happen.
Is that your summary of things, Tom? And then it happened.
No, but then it happened. And that, my point here is we need to be prepared for the unexpected in Europe, whether it's 50 beeps or 75, because Lagarde has to frame out what the end of the year looks like. Do we know what the end of the year looks like?
I don't know what next week looks like, Tom.
Yeah.
Never mind the end of the year. What I do know is what they're telling us, Lisa, and what they're telling us right now over at the ECB is that even if we have a recession, we have to keep on going. We have to keep on going.
There is a penalizingly high inflation rate that they are committed to getting down. There is a unified message, not just among the Fed, but also central banks around the world. This is the primary concern, inflation, even as they see the concerns of woes, which raises a question going back to your first point with stocks. Why are they not more concerned about the consequences to earnings from slowing growth?
Mike Wilson at Morgan Stanley is. You read that note, I read that note. That was the pushback. Tommy said the first half was all about Fed rate pricing, Fed rate risk.
Yeah.
The second half is going to be about earnings, and he thinks there's a lot of space to the downside there.
What we're going to do this morning, folks, and this is, of course, the combination of equities, bonds, currencies, commodities, is consider the bears who've been successful. Douglas Cass nailing it at Seabreeze on a short-term basis. And as John mentions, Mr. Wilson over at Morgan Stanley absolutely nailing it on a more long-term measured, let's call it institutional basis. In the storm is Andrew Slimman, Mr. Wilson's colleague, senior portfolio manager at Morgan Stanley, Chicago. Andrew, thank you so much for joining us in this turmoil. You go as a guy more optimistic where Mike Wilson goes, which is now we must study earnings. And you suggest that margins must be maintained. Can we be optimistic for maintained margins through the end of the year?
Well, we certainly haven't seen the earnings collapse that many of the bears have predicted. We'll have to see. I would say from a stock picking standpoint, it's better to find the companies that actually already have had the earnings collapse. I think he's talking at the S&P level. We'll have to see. The counter argument is that we are still only 2 years from the previous recession, and therefore balance sheets can withstand the shocks that you're seeing to costs and so forth better than they would if we were, coming off a long period of economic prosperity.
With a 2-year back to an autumn 2007 yield, is cash attractive? Is a legit asset?
Yeah, yes. And the point of this is I am in the camp of PE compression. So I think that is the negative. The Fed raising rates, yields going up, pushes the PE down, and that's the negative that I see. I just haven't embraced as much the earnings collapsing side, which is the positive. And that, to me, has been the story of the year. And we got a little bit, we had a very big bounce off the June low on the fact that the second quarter was not as bad as expected. And, now we're pulling back. That's the push-pull of, they're very much a lackluster year for equities, and I'm still in that camp.
Andrew, as you know, the bond market backdrop changed as well since the middle of June. It's back to where we were. So here's the question about the June lows in the equity market. If the 2-year yield is back through the June 14th highs, why do equities belong anywhere near 10% above the June 16th lows?
Probably not. They probably will head lower. I think, September is not a great month, but I still think we could get a, late rally in the fourth quarter as the market starts to price off, next 4 quarters of earnings, which is 2023. But, look, we've had a big bounce. High risk came back in the market very quickly. And I think that's, that was a dangerous sign. So Jerome Powell getting up and saying what he said, and boom, down goes all the speculation that had come quickly back in the market. So I think the near term it's negative for the market. Will we hold the lows of June? I think it's possible, even with rates higher. But I think speculation is right for short-term speculation, right, to be, washed out.
So you sound really bearish, Andrew, and you're talking about reducing risk. And then I look at some of the stocks that you like, including Restoration Hardware, Lululemon, among other consumer discretionaries that usually do worse during downturns. What gives? What's the rationale?
Yeah. So first of all, at the macro level, consumer sentiment hit a 44-year low in July. So a lot of very negative views. And when you think about that, it's all the stock market rewards the direction of change. And so inevitably, direction change, it's got to go high at some point. It has, and it has improved. And then from a stock standpoint, those stocks are down 40, 50, 60, 70% peak to trough. There is just a ton of bad news priced into it. So I guess going back to the original question of earnings, these companies have already brought down their numbers. The market is pricing in as if they're going to miss earnings. So I think that it's safer to buy companies that have already, the expectation is bad. I always am interested in buying companies with great long-term track records that the stocks are down a lot with a lot of negative expectations. So I think that's safer than thinking you can pick and choose companies that aren't going to have earnings problems.
Following that logic, Andrew, do you think that the opposite holds true, that you should sell the names that have held in better? I'm thinking of big tech that have had incredible rallies over the past few months.
Absolutely. I think it's very dangerous. Be careful if the Mike Wilson scenario comes to bear. I don't want a stock that's down from its peak, 5%. I think there's a lot of risk in that area, and I'd rather buy the companies that are already priced in a lot of bad news.
How do our listeners and viewers do, Andrew, if everybody's buying 4 or 5 stocks, which were X% of the bull market rally out of June, and then you've got to look at everything else? Do you participate in those glory stocks and figure out what to buy? Or do you finally jettison the glory stocks and actually run a diversified portfolio?
Well, yeah, I mean, I think there's plenty of companies out there that are down, a lot, as I said, and there's real opportunities. But those very big stocks, some of them are really not down that much. And if you go back and look, Tom, at the history of the S&P, what brings down the largest companies? They never stay on top forever. It's usually the government. And I think, you've got a very high weighting in a few names, and that is going to weigh on the S&P at the index level, I think, for the next few years, which will be good for investors that go out and buy individual stocks, because I think the opportunity set is probably better at the stock level than the index level, just given the weighting in those few names at a time when the government is, like I said, starting to, nose in some of these companies.
Andrew, got to squeeze this in. Energy, winner of the year, at 49% on the S&P 500. Jeff Curry and the team over at Goldman. They're telling people to keep buying commodities, even going into what could be a recession. They say the following: commodities are the best asset class to own during a late cycle phase where demand remains above supply. Andrew, where are you on the commodity equity side of things, the energy equities, which have delivered some stellar returns this year?
So Lisa listed some stocks that we like. We got to sell something to buy them, because I'm a long equity manager. What have I been reducing? Energy. And I've been reducing energy because just what you said, it's up significantly, 49%. This industry is classically cyclical. And if, in fact, the economy does weaken, to me, energy is vulnerable because it's done so well versus stocks that, were listed that are already down a lot. So I think energy is a source of funding. It's come roaring back here. I would continue to view it as a source of funding. So I'm, the fat pitch in energy was a year and a half, 2 years ago, when the forward curve was negative
prices.
I think the fat pitch right now is that sentiment is at a 44-year low. I think that's the opportunity, and you sell things that are done very well, like energy.
Andrew, thank you. Andrew Sliman there of Morgan Stanley Investment Management. TK, his view: sell the energy winners and allow that to fund some of the beaten up players in retail.
Everybody talks about buy low, sell high. And what's really, really difficult to do, John, is to sell high and then rebuy low.
Yeah.
Way, way harder.
I couldn't agree more, Tom.
Was that smart? Did I do
Always
it
great
okay?
with hindsight to look back at that moment in spring of 2020 and say, that was the easy point to put some money to work. Lisa, it didn't feel that way at the time, did it?
Yeah, the easy money was made right after that. It felt really easy. I kid, especially after trading was halted for however many days in a row. What he's talking about, though, is really controversial, and I'm glad you brought up the Goldman point. People saying that a recession will dampen the prices of oil and gas. That's the Andrew Sliman potential point of view. And then others saying there still is demand and not enough supply. Period, full stop.
You know why Resto works? RH always delivers on time. They're so
when
good
have
at
you
that.
ever bought something from Restoration Hardware?
John,
Plenty of times.
Really?
Yeah, of course.
John, we
got to deliver on time. Their logistics through this have been so much better, Tom, than everyone else.
That's true.
Everyone else I've dealt with. This is very personal.
Okay.
I'm surprised.
John,
You're a fan of Restoration Hardware.
Is she gloomy or mountain time or Eastern time?
I actually would like to
I think she's still on gloomy mountain time, Tom.
Yeah, I think it's mountain gloomy time.
Without a doubt. Lisa didn't get any rest this weekend. Futures down 9/10 on the S&P. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Senator Elizabeth Warren has taken aim at the Federal Reserve's plan to fight inflation. She told CNN she's worried the central bank will tip the economy into recession. Warren said there's something worse than high prices and a strong economy, and that's high prices and millions of people out of work. If an Iranian nuclear deal is reached, Tehran may be able to put millions of barrels of oil on the market almost immediately. It's estimated that Iran has up to 93 million barrels of crude stored on ships in the Persian Gulf, off Singapore and near China. A nuclear deal would most likely lead to Iran being allowed to sell oil globally again. In California, Governor Gavin Newsom has introduced a bill to keep the state's last nuclear plant open. Newsom argues that keeping PG&E's Diablo Canyon plant operating past its planned closure in 2025 is needed as the state transitions away from fossil fuels. Still, Newsom's fellow Democrats in the legislature are skeptical. Honda and South Korean battery maker LG Energy Solution will spend $4.4 billion to build a battery factory in the U.S. The Japanese car maker wants to phase out fossil fuel vehicles by 2040. The location of the plant hasn't been decided. Bloomberg reported in June that Ohio is a front runner. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Lots happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
We think that's the next secular shift.
From businesses most influential and instrumental.
Yes, it's about renewables.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
You do not get stronger that moment that you're lifting the barbell. You get stronger as your body is making repairs, making recovery. Recovery is a when and how you get fitter, faster, stronger.
Recovery technology includes everything from massage guns and foam rollers to compression boots, hyperbaric chambers, cryo chambers, infrared saunas, and even infrared pajamas. And athletes are partnering to become investors to take those products mainstream.
When you look at tech in sports right now, it's completely innovating the way training's going, completely changing the way recovery's going. I think sky's the limit as far as where it can go.
But while some of these products can feel amazing, it can be difficult to differentiate between what really helps the body and what just tricks the mind.
Every time you're chasing the latest, greatest, newest tool, you're probably chasing a mirage.
We
can't just rely on markets. We have to get our rate up to the level that will put downward pressure on inflation. I've said 3.75 to 4% by the end of this year. I'd like to get to that level, and sooner is better as far as I'm concerned.
The St. Louis Fed President Jim Bullard there catching up with us, going into the weekend on Friday in Jackson Hole. From New York City this morning, good morning with Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Futures are negative again, down 8 or 9/10% on the S&P. On the NASDAQ 100, down by 1 full percentage point. Yields are up by, let's call it 6 or 7 basis points on a 10-year, through 3.1% at 3.1061 on a 10-year in America. TK, Chairman Powell on the neutral rate. Jim Bullard very much on the same page. President Bullard didn't even want to talk about where he thought the longer run neutral rate was. I don't think he thinks there's much value in that exercise right now when they have so much work to do. I think Chairman Powell framed it quite nicely in the speech as well. Estimates for longer run neutral rate are not a place to stop or pause. I'm not even sure they're relevant right now, Tom, to this big debate.
Yeah, that's the key phrase, John. Relevant now, they're not. And also, it's very squishy math and a really uncertain time. But what was so interesting with Bullard, John, is his idea of a regime change 7, 8, 9 years ago, whatever it was. And you wonder if we're at a regime change right now.
Elisa tried to drive that home a couple of times. I'm not sure they want to jump on board with that just yet, Tom. They're talking about raise and hold, but this idea that perhaps this is the new regime of higher inflation and higher rates, and we could be living with it, Tom, for a whole lot longer.
We'll have to see. Futures at negative 34, the VIX out almost 2 points, 27.21, some legitimate tension with record dollar strength off the good Bloomberg Dollar Index. Part of that, of course, is commodities. We're looking at all the asset classes this morning in this turmoil, this reset into the end of the year. Ellen Wald provides advice, senior fellow at Atlantic Council, I should say, in her definitive efforts, Saudi. I can't say enough about the terseness of her book, Saudi Inc. Just a really wonderful walkthrough of the originality of what we see in Riyadh. Ellen, I want to talk what John mentioned earlier, which is the idea of the U.S. as a global manufacturer of hydrocarbons, and a select few saying it's un-American to export the stuff. Discuss that as the adult in the room.
Yeah, I can understand where these people are coming from, especially because for so long we did have a crude oil export ban, but you have to remember that really is only a very recent phenomenon. We only had a crude oil export ban starting in the 70s during the when we had the oil shocks, and the idea was to try to keep as much oil as we had at home. Before that, America was a major supplier of energy to the world. Basically, during World War II, American crude oil, American energy, American gasoline and diesel and jet fuel was essentially, you could argue, responsible for winning World War II for the Allies. So I think to say that it's un-American to export our energy products is a very short-sighted view of America.
So, Ellen, the Department of Energy, led by Secretary Granholm, appears to be very concerned about the low stockpiles of diesel and gasoline, particularly in the Northeast. This is what she said in a letter to some of the energy players here. It is our hope that companies will proactively address this need, or, quote, the administration will need to consider additional federal requirements or other emergency measures. Ellen, how credible is that threat?
I mean, if that's not a threat, then I'm not sure what is a threat. I mean, she pretty much laid it out, saying if you don't get American stockpiles up, if you don't stop exporting products that are commercially viable to export, then we're going to ban the export of certain products. And that's I think very damaging to the global energy market, because the United States is an important participant in this global energy market, and we import tons of products as well as we export them, and that's what helps things run smoothly. Right now, the prices in Europe for diesel, for liquefied natural gas, for all sorts of products are much higher than you can get in the United States. And so that's why we're seeing a lot of products go to Europe, especially because Russian products are no longer available for these places to import. If we wanted to correct this, we could stop sanctioning Russian exports, or Europe could take a hard look at it. It's the answer to this problem is not to say don't export or we're going to ban exports. The answer is to look at the larger flow of products and figure out, where things could be improved. For example, they could get rid of the Jones Act or suspend the Jones Act, which would make it much easier to transport diesel from certain places in the United States to the Eastern Seaboard where diesel supplies are very low.
Well, there's a question about whether Jennifer Granholm has credibility within the energy industry at this point. We could get into that. Perhaps a little more instructive is what companies are actually doing, whether they're going to actually invest in producing more natural gas, producing more crude products in the United States. What do you see on the investment side at a time when prices, while they have come down, are still much more elevated than they have been in years?
You would think that ordinarily when prices are high, that there's a much higher level of certainty for producers to say, okay, we're going to invest, we're going to produce more. But right now, at least according to the survey that the Dallas Fed and other Feds have done of energy producers in their regions, show that actually there's a very high level of uncertainty. And a big part of that has to do with inflation and supply chain issues. A lot of producers are finding that while they thought that their costs would go up maybe 10%, they're finding that costs are up 25% or higher. And that's really hurting their ability, even those that want to produce more, that want to drill more, that want to open more wells, they're finding that this is very difficult. They don't know where they can get the steel. They don't know where they can find labor and sand and other inputs that they need in order to get these wells going. So wells are taking at least 7 to 8 months to complete, whereas before that timeline was much, much shorter.
Can we just probe the tail risk here, just to wrap up, Ellen? What do you think would happen if the administration curtailed the export of fuel, of energy product to, say, Europe? What would happen? What would the main characteristics of the energy market look like in that world?
I think that the first thing we would see is a major spike in the price of fuel products and oil all over. I mean, speculators would just, ramp things up. I mean, it would be such a high, increase that maybe the likes of which we've almost never seen, or at least even if this was just foreshadowed, we'd see a jump in prices. And then we'd probably also see some issues in terms of WTI, that we'd see a much bigger differential between Brent and WTI developing.
Ellen, thank you. Ellen Wald, the Atlantic Council. I'm not sure that's the base case yet, Lisa, but it's certainly the tail risk, and that tail risk has been highlighted by Secretary Granholm in the last week.
You could say that she's not credible, that she does not have the support of the administration, but why is she still part of the administration if she's going to come out and send a letter like this to members of the oil and gas community, basically saying, you're issuing a threat?
Then that's a question for the president, Bramo. I'm not sure I can answer that one.
Well, but I guess that the question that I have is, okay, is this a tail risk? It's not a base case,
sure.
But then why is she putting it out there? What is she hoping the response will be?
Tom asked a similar question earlier. TK, when you said, did the State Department know about that letter? Did the White House know about that letter?
It's politics. You're going to get competing forum. And let's remember that she is a former governor of Michigan, so she's adept at the political debate of the moment.
Futures down 0.8% on the S&P from New York. This is Bloomberg.
So is there more pressure when you're trying to win a basketball championship than when you're trying to please investors? Where's the greater pressure?
Oh, I think it's definitely trying to win a championship. it's hard because a lot of, like when you invest, and you know this, when you're investing, you can control a lot more things. When, you know, on a basketball court, you can't control whether somebody's going to make a shot. You've got to get lucky.
And what's the greater pleasure, making 5 times your money on a distressed debt investment or winning the NBA championship?
They're both fabulous. I wish I could do one each year. That would be great. But I think there's a great feeling in being right on an investment that you've done a tremendous amount of work and you've made money for your clients, which I think is great. I think winning a championship it's a very surreal feeling because there's a whole city or state that is actually behind you. You know, we had 70,000 people at the finals, and we had them all outside. You had 17,000 in the stands, and then literally like 60,000 people outside. And when we won, like just the joy that you had brought to the city was phenomenal.
No one covers the world like Bloomberg.
We have to get interest rates higher and bring inflation back to our targets.
Spare capacity is becoming scarce. We are running on thin ice.
No one deliberately wants to go into battle, but we sleepwalk into conflict.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority. In a $7 trillion industry, there's a lot of ground to cover.
Prepare for an economic hurricane.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Getting inflation down to 4% is not getting the job done.
They're going to knock down inflation. It's going to be painful, but they're going to get it down.
The inflationary pressures, both demand and supply, are leading to these bigger problems.
Maybe inflation is peaking, but it still remains way too high.
What I'm concerned about is that on the current regime, the central banks are set up to fail.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Still shivering from sitting out in that field for 5 hours. Live from New York City this morning. Good morning, good morning. For our audience worldwide with Tom Keene and Lisa Abramowitz, I'm Jonathan Farrow. This is Bloomberg Surveillance with equities down 0.9% on the S&P 500. TK, the J. Powell pushback. Here's the fallout.
Well, there it was. I mean, remember, John, when he spoke and we were sitting there in the ice looking at a modest market reaction. Boy, John, what a reassessment as we went out to get back on the Gulf Stream.
Ripped the floor out of this equity market, wow. Tom, and then adding to it, the ECB over the weekend, TK. The ECB and the Federal Reserve with a similar message. Even if the economic growth looks weaker, we'll keep hiking to get inflation down.
This is really important. We've mentioned it twice before, and we'll mention it through the week. Right now, for those of you in America, ECB really matters. We've got the expertise of John Farrow before he could drink in a pub, servicing in Frankfurt. And John, is this ECB, John, anything like the ECB that you knew long ago and far away?
Radically different. For one, Tom, it's hiking interest rates, and the whole of the previous cycle, they didn't do that at all. Back to Trichet in 2011, he was hiking interest rates, but inflation, Tom, then was closer to 2%, and this one is closer to what now? 8%, 9%, pushing 10%?
But the same question is there. How do they hike into Eurosclerosis, even if it's war or no war?
They're telling us they'll hike into recession, Lisa. They're telling us that they will hike even if it looks like we're in a recession. That's the communication, not from some random governor of some random place. It's from the board, the executive board of the ECB.
Perhaps it's easier, though, to talk tough. than to do it. And this is really going to be the key distinguishing feature going forward between the bulls and the bears. At least that's the camp that we're seeing right now. Whether people believe that they have Fed, whether the ECB will follow through on tough actions. And Bill Dudley wrote a column to this effect this morning, basically saying they need to follow it up with actions, even as they will have hiked rates by 275 to 300 basis points in 6 months. Just giving you a sense of how much the scope has been and how much it needs to be.
What did you make of the length of the speech? 8 minutes, very targeted, very concentrated. Did that work for you?
He laid it out at the beginning. He said, I want this to be focused. I want it to be clear. Inflation, 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 plus 42 other times he mentioned it. And then guess what, guys? We're going to do what we have to do.
John, as I went out of the lodge with my entourage, not one but two former Fed officials stopped me and emphasized how much they agreed with the brevity of his speech.
I think everyone's on the same page after that, Tom. And I think for a lot of people, the criticism came from the performance in the news conference at the last Fed meeting. And it is littered with quotes, literally littered with quotes, Lisa, addressing some of the issues that were raised after that news conference.
Basically saying we're going to do it for a long time. Basically, read between the lines, we're not going to cut rates. Read between the lines, we're not going to back away if the economy does turn. But what about the balance sheet, which they did not mention? What about what they got wrong in the assumptions? They also did not give a sense of. And what about the framework that they will look at this data in their data dependency?
That's the essence of the Mohamed El-Erian piece in the Financial Times.
Correct.
It's not just about the present, it's about the past, it's about the future, and we can pick up on that in just a moment. Futures are down about 1% on the S&P 500, on the NASDAQ 100 down by 1.16%. So equity softer, lower, negative. We're heading south. Yields heading higher, up by 6 basis points, 3.1% on a 10-year, 3.10 to 4%. And an ECB, we're not just considering a 50 basis point hike. We might be talking about a 75 basis point hike. Lisa, and QT, euro dollar, firmer, 99.85.
Yeah, it's really shocking considering where the ECB has been, even possibly more shocking, at least in a divergence from negative rate policies than over in the Federal Reserve in the U.S. Fed Vice Chair Lael Brainerd today is going to be delivering remarks at a pre-recorded event at Fed Now in Chicago, a workshop there. She will talk, I'm sure, about what Fed Chair Jay Powell said over the weekend. I want to hear what she has to say about the balance sheet. It is going to ramp up in terms of its unwind. And there is a lot of question around what the impact will be, especially because there was a paper that was presented at the conference. And basically, the nut of it is it will introduce a lot more liquidity concern, Tom, that people are not perhaps expecting.
Well, you know, John, we'll have to see. I mean, was there any talk of the balance sheet anywhere? I mean,
we talked about it a little bit in some of the interviews of QT, but I don't think they understand the consequences of QT, reducing the balance sheet by $1 trillion and what it will mean for financial conditions. So I don't see how they can make a call on what QT means, Lisa, for this market and ultimately what it means for rate hikes.
And ultimately when they will stop if they see some of the constraints with liquidity. Also today, German Chancellor Olaf Scholz is traveling to Prague to speak with the Czech Prime Minister. Front and focus very much the energy crisis. We are seeing a little bit of a reprieve in natural gas prices, but German power prices, power valuations still skyrocketing at an exponential pace. And at 10:30 a.m., we get U.S. Dallas Fed manufacturing activity for the month of August. I know you all have been at the edges of your seats for this report. Perhaps not one of the most important data points that the Fed is tracking. However, perhaps a hint ahead of the ISM manufacturing report on Thursday. And John, you've talked a lot about what will it mean if you start to see that material slowing in the economy. Then the proof is in the pudding, right? Then the Fed has to respond and continue tightening, even in the face of weakness, which becomes a much harder task.
We ignored the S&P Global PMI.
Completely.
I don't think anyone's going to ignore an ISM if it looks like that. Lisa, thank you. Let's get to Peter Cheer, the head of macro strategy at Canopy Securities. Pete, let's start here. The Fed is telling us that they will keep hiking rates even in the face of weakness. Do you believe them?
To some degree. I think what they've done is shift really the scale. So if we got bad economic news, say on a scale of 7, the Fed might respond in terms of an 8 or a 9. Now they might respond in terms of a 4 or 5. So they will continue to hike with some bad economic news, but they will not be over the top, right? If we really get weakness, if we get jobs going down, they will have to backtrack. This was really about resetting expectations. They had a perfect opportunity. They did that. They'll continue to do that this week. But the reality is they are going to be data dependent.
Well, they're going to be data dependent, Peter, but which data? I'm confused now because I've got equities moving, bonds moving, currencies, dollar out to record dollar strength, and even commodities giving me some movement as well. Which data dependency matters to the Fed?
I think jobs are going to be important. I think, to me, they're going to start watching this inventory build and whether that translates into lower economic output. And then finally, we do have two threads, and I think you did a great job mentioning this earlier. QT is starting to ramp up, and I think QT behaves very, very differently than rate hikes. I think QE really helped inflate all asset prices. You know, I've always talked about this as being like a Newton's cradle, you know, where you drop the ball at one end and it knocks all these things and the ball at the other end moves. So if that's what QE did and really pushed out asset prices, especially on the most risky assets, I think you're going to see the reverse of that. And that's one reason the long end of Treasury yields are behaving poorly this morning is people are starting to realize QT is coming, this balance sheet reduction is here, and that behaves differently than rate hikes and goes directly to asset prices.
Peter, can we talk a little bit more about that, particularly with respect to the paper that was presented over at Jackson Hole, talking about how this directly feeds to the leverage given to a lot of hedge funds, a lot of traders, and how that taken out of the market leads to a lot more volatility and a lot more sudden potholes in price valuations. What could we be set up for if it is as follows, if it is as fears in terms of the withdrawal of liquidity?
So I think it's going to do two things. One is it's going to allow everyone to move slightly down the risk curve, right? So if you wanted to buy dividend stocks, now maybe you can buy high yield bonds. If you're buying high yield bonds, you can buy IG bonds. If you're buying long duration bonds, you can buy 5-year treasuries. So I think you're going to see everyone move down the risk curve. So I think that is going to be tough for stocks to overcome. I think it's going to be very difficult for high yield and leveraged loans. I think we're going to be okay at the front end of the curve. So that to me is the main thing this is going to do is allow everyone to shift down risk, and that's problematic. And then the other thing we're all going to be questioning is how liquid are these markets, right? Friday was ugly, but Friday was in a very thin market. And what I find most difficult to talk about is if you go back to last summer when the Fed insisted on doing QE, they kept talking about market liquidity as the reason to do QE. I can guarantee you that market liquidity, especially in treasuries, is way worse now than it was last summer.
Pete, I get very uncomfortable with a very comfortable consensus. 12 months ago, it was transitory, and now it's short and shallow. And this recession idea is something apparently for next year, for 2023. We got a real sense of that in Jackson Hole, that everyone was lined up to say almost the same thing, Pete. What do you make of that?
I'm actually much more bearish than that, and I'm not bearish because of how I think the Fed policy is going to be. I think we've already turned the corner on the economy in a negative way. We're seeing things roll over, and I'm willing to bet that by December, we're complaining about deflation and real problems in the economy rather than inflation. I think we've gone too far too quickly. Things are turning, things are rolling over. I don't like what's going on in crypto and disruptive stocks. I don't like what I'm seeing in housing. So I think people are being far too complacent.
Fascinating. Pete, thank you. Peter Chi of Academy Securities. TK, he's essentially saying we've already made the turn, that this is not just about the Fed now. This has taken on a life of its own. And for Pete, at least, it could be a whole lot worse than this short and shallow consensus you hear so much of.
And that's, John, seriously, one thing I'm a little blurry on here is the state of the housing market. We've got housing data coming out this week. I understand that, but I just don't have a handle on how housing and rent fits in to some form of growth slowdown.
Well, before this plays into rents, Lisa, we might have to wait a while. And that seems to be the general view of a lot of people.
Yeah, and what happens while we're waiting, especially with financial conditions, especially with market functioning? And this is where the fear comes into play. When you start manipulating markets in this kind of way and removing some of the liquidity, do you get accidents? Do you get some sort of financial market disruption that accelerates a downturn in a way that perhaps is not exactly what the Fed would like to see?
To get inflation down, there's a price to pay. And they're willing to pay that price. And I think that was the main takeaway, Tom, after Jackson Hole on Friday and through the weekend, and not just from the Fed, but from the ECB as well.
Yeah, and what's going to save them is technology, John. Augustin Carstens, in his lunch speech, I thought was just brilliant. It recapitulated what he told Chris Giles in the FT, and he mentioned technology as being absolutely the separate feature. And I think the optimism that the optimists have is about technology.
Speaking of tech, Tom, do we have a rocket taking off in an hour and 20 minutes or not?
This is a huge, huge deal. Elon Musk's not involved. Jeff Bezos is not involved. What's involved is our collective memories. This is the new Saturn V rocket. And John, it is frozen on the runway right now. Associated Press out with a blistering story of cracks in the fuselage. John, that harkens back to the Challenger space shuttle disaster. Right now, at this moment, there are really, really nervous engineers at Cape Canaveral.
And Tom, you can tell us more about that through this morning with Tom Keene and Lisa Bramett. I'm Jonathan Ferro. Futures down 1% on the S&P, live from New York. Good to be back, isn't it, Bramo?
Yeah.
It's nice to be back. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Fuel leaks and a possible crack are threatening to delay the test flight of NASA's new moon rocket. The uncrewed Artemis 1 mission is set to lift off today from Kennedy Space Center. It's scheduled to circle the moon in an orbit that will take it deep into space and then return to Earth 42 days later. U.S. Navy warships have sailed through the Taiwan Strait for the first time since House Speaker Nancy Pelosi's visit to the island. That trip strained relations between the U.S. and China and led to Chinese military exercises around Taiwan. The Navy says its ships were demonstrating the U.S. commitment to a free and open Indo-Pacific. China is moving aggressively on COVID as a meeting of top Communist Party leaders approaches. Authorities are enforcing lockdown restrictions in areas around Beijing more intensively, and they'll mass test the port city of Tianjin. Elon Musk says the world needs more oil and gas now to deal with an energy shortage while it pushes to transition to renewable fuels. The CEO of Tesla told an energy conference in Norway that he's not one to demonize fossil fuels. Still, Musk said there must be a clear path to a sustainable energy future. Trademark filings suggest that Apple may have settled on potential names for its highly anticipated mixed reality headset. Applications were filed in a number of countries for the names Reality One, Reality Pro, and Reality Processor. Apple is aiming to release the headset next year. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Ritika Gupta. This is Bloomberg.
Apple has identified its next big business, bringing advertisements to more parts of your iPhone. Today, Apple pushes ads in 3 places: the App Store, Apple News, and the Stocks app. In the News and Stocks apps, Apple shows display advertisements. That means that third-party companies like car dealerships or mortgage lenders can showcase their advertisements just like they can on a website. On the App Store, the situation is different. There, Apple has search ads. This allows developers to buy their way into showing up higher on search results. For instance, an App Store developer can bid for the term car racing or basketball so their apps would surface above competing apps in the list of results. Apple's push into ads is a little ironic, given that its ATT, or App Tracking Transparency Privacy feature, limits the ability for Meta, Snap, and even smaller developers to generate as much revenue as possible from advertising. That's because the feature allows users to choose if they want their data collected and tracked across third-party apps and websites. Still, Apple's hoping to expand its own ads business and is planning to add search ads to its Maps app. Other areas where ads could eventually appear are in Apple Books and Apple Podcasts, along, maybe one day, with an ad-supported tier of Apple TV Plus to compete with new offerings from Netflix and other streaming video providers. I'm Mark Gurman. This is Power On.
The difference between political gossip and policy intelligence. Bloomberg Government provides our clients with expert reporting, analysis, and public affairs tools that give you the edge in reaching policymakers on the Hill. When you're in the business of influence in Washington, information and connections are the currencies on which you rely. For knowledge you can act upon, the difference is Bloomberg Government.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
When the Fed gathers at Jackson Hole,
this is not a normal Jackson Hole.
Our expert team is there.
Michael McKee, Jackson Hole, Wyoming.
What is your baseline?
First with news.
We will keep at it until we're confident the job is done.
First with names.
Inflation is too high, and we're going to do what we need to do.
Sooner is better, as far as I'm concerned.
First with analysis.
The Fed has to be harsher than expected.
Central bank mea culpa.
You may well see more unemployment.
I don't think this is a time to declare victory over inflation.
When it comes to the Fed, Bloomberg has you covered first.
You know what's worse than high prices and a strong economy? It's high prices and millions of people out of work. I'm very worried that the Fed is going to tip this economy into recession.
Senator Warren, the Democrat from Massachusetts, on CNN. Are we going to hear a whole lot more of that in the months to come? From New York City this morning, good morning, with Tom Keene and Lisa Bramford. I'm Jonathan Ferro. Futures down 1% on the S&P. On the NASDAQ 100, down by 1.25. Yields are higher on a 10-year by around about 7 basis points, 3.10, 80% on a 10-year yield. Your 2-year yield through the highs of the middle of June in the FX market. Your dollar was a little bit stronger this morning. It's weaker against the euro now. Euro stronger, 99.83, Tom, on euro dollar, with yields on the periphery and in the bond market a whole lot higher this morning.
In 20 minutes of deterioration here, John, you wonder if we're going to get out to the 3-0, the emotion of a 30 VIX. We're not there yet, 27.59. Right now, we're going to look at the economist, Senator Warren of Massachusetts, rather. I'm kidding. She is truly expert at bankruptcy law, but opining on the Fed. Jack Fitzpatrick joins us now, Bloomberg Government in Washington. Jack, this came up in sensitive moments at Jackson Hole, the independence of this Fed. Give us a clinic on how independent this Fed is in Washington.
Well, I think for one, it is notable that, yes, you're hearing pushback and concern from a high-profile senator, but Senator Warren is kind of representative not only of the progressive wing, but she has her concerns and is vocal on monetary policy. If you're going to hear pushback from someone who's concerned that they're going too far with rate hikes, it's probably going to be Senator Warren. You are not seeing that, at least not yet, from leadership-aligned lawmakers. You're not seeing, it doesn't seem you're seeing anything from the White House that would express frustration with them. So maybe it's so quiet because it's August recess. Maybe we'll hear more from other progressives. But right now, I don't think this is truly a huge amount of pushback. It's notable, but I wouldn't say it's something that threatens the sense of the Fed's independence.
But if we get there, and I'm not, I've got my own opinions, I'll keep them out of it. But Jack, if we get to a growth slowdown of some flavor, this is equal opportunity. We've got the economist Warren from Massachusetts. We've got the economist from Kentucky, Paul, the libertarian, and they're on the same page. Jerome Powell's a piñata. What's going to be the level of piñata if we get flat GDP for an extended time?
I think you may see more blame from the progressive wing. This is an issue that lends itself pretty easily to Republicans blaming the Biden administration and the stimulus. That's the line heading toward the midterms. I think it would probably be the Republican line beyond that. So if you're seeing frustration with the Fed, if things get really bad, it would, I think, spread beyond Senator Warren, but it would primarily and at least initially come from the progressives, and it would be very notable if you hear it from leadership-aligned Democrats. I would suspect that Republicans would continue to be much more focused on criticizing the Biden administration than the Fed, given the politics of it all.
Elisa, we're not seeing more of this because unemployment is at 3.5%. We're not seeing more of this because everyone in the White House keeps saying the economy is so strong. The real test for the independence and support of independence of this Fed is if the mandate's in conflict. If you have unemployment that starts to climb higher and inflation's still sticky, how much do they support this Fed bringing inflation down? And how does this Fed communicate that higher unemployment is a price worth paying to get inflation down. That's when things get harder. That's when I imagine we'll hear more than just the likes of Senator Warren saying these things.
It's harder on both sides, though, because at the same point, Jack, you see right now this idea of perhaps the Fed could curtail growth or curtail the economy so much that it goes into recession. But if we start to see that and inflation is still high, what's the remedy? What more can the administration in Washington do to bring down inflation from the other elements, from the other sides, aside from just looking at the demand side suppression of a Fed policy response?
There are theoretical solutions, but if they could flip a switch and end the war in Ukraine or reduce supply constraints tied to uncertainty around the coronavirus and that kind of thing, they probably already would have. That's something that Senator Warren got into, and that is the progressive, maybe MMT-aligned critique of this kind of action by the Fed, is that it doesn't specifically target the key supply constraints, but how much can the Biden administration do if that's the case? In a perfect world, the constraints being applied by the Fed would not be necessary. You may hear more of that critique from progressives, but there's a reason this is necessary in the first place.
One thing, Jack, we're hearing a lot of criticism about is the student loan decision in the last week. Some reports, Jack, and I wonder what your reporting's indicating, that apparently the Secretary, Janet Yellen herself, didn't agree with the decision, and even the First Lady didn't agree with the decision. Where are those reports coming from?
I've seen a mix of reporting. I believe I had also seen some of our own colleagues reporting that some of the progressives pushing for this had been pushing the First Lady to get her on board. I'm not sure about the First Lady's own opposition, because to some senators who wanted potentially even more than $10,000, $20,000 for Pell Grant recipients, they had sought out Dr. Jill Biden to get her on board. So there was a bit of a mix there. It was notable that there was some hesitance from the Treasury Secretary.
Yeah.
But overall, I think a lot of the conversation was something was going to happen. How high could they get that number? And clearly there was a lot of success, because they largely got this from $10,000 to $20,000. So the supporters clearly had a significant victory there.
Hey, Jack, thank you. Jack Fitzpatrick down in D.C. TK, once again, another example of the Treasury Secretary, Janet Yellen, being somewhat marginalized potentially on a massive issue.
Yes, I think it's very true. It's almost a shock, John, to see Yellen in the zeitgeist this weekend over the student loan debate. But it has been, to be polite, an odd Treasury. I don't really know what to make of it.
It's been a quiet one, Lisa. Let's be more diplomatic about it. It's been a quiet one.
Yeah.
Well, perhaps silenced one, right? The sort of economics meets the politics, and when the economics and politics don't mesh correctly, maybe you silence some of the economics and go with the politics. Is that possibly what we're seeing?
Something like that. Futures right now, down 1% on the S&P. I'm behaving. I'm not saying too much.
I know. I'm impressed. You just don't let me throw myself
out. You wouldn't say too much either if you were that cold.
very transparent to the shopper before they accept an order, what the order is going to look like, how much we're going to pay them, and how much like the consumer is paying them. And so they can decide whether they take an order or whether they refuse it. And that's the kind of flexibility that our shoppers really value and the kind of transparency that they want.
Are you seeing a labor shortage right now? And what are you doing to combat that?
It's different in different places. Our demographic of shoppers is completely different from food delivery and ride sharing. We're 70% women and half of them are moms. And that's because a lot of the job at Instacart is very different than just being in a car with strangers. It's about like going to the store, doing a good job of customer service, of really picking the right products for the consumer. And we are seeing that being very appealing to women.
Welcome to the world of decentralized finance.
I'm going to take a look right here at regulation.
We are seeing digital currencies under some pressure.
Bloomberg's covering all things crypto. The people.
I want to have some of my money outside of the sovereign.
The transactions.
It all comes down to the details here.
And the technology.
How does that affect disruptors like you?
What happens to everything that you're investing in when the last Bitcoin is mined?
Bloomberg Crypto, Tuesdays.
Live from New York City this morning, good morning. It is feeling more and more like the middle of June. On the S&P 500 on Friday, the biggest one-day drop since the middle of June. On the NASDAQ 100 last week, the biggest weekly drop since the middle of June. And this equity market on the S&P still about 10 percentage points higher than the middle of June, but the two-year through the June highs this morning. Very, very close to 350. Your bond market looks like this. Your two-year right now in and around the year's highs at about 345, 344.77, yields up 5 basis points on a 2-year, on a 10-year, up 7 basis points to 3.1098%. Mike Wilson this morning putting out the note over the weekend for you all to read through this Monday for your week ahead and saying the following. The first half was about the Fed. The second half is going to be all about earnings, and he thinks the scope for some disappointment, a lot of move to the downside still to come apparently. And this Fed is communicating the following. We'll keep on hiking, and we'll keep on hiking into weakness. The ECB goes one step further over the weekend. Here's a snapshot of the euro. The ECB, an executive board member, Isabel Schnabel, suggesting that even if we face recession, we have to keep on normalizing to get inflation lower. This sets us up for a really interesting conversation on September 8th. The prospect of maybe, I stress maybe, a 75 basis point move. The conversation somewhere between 50 and 75. A report suggesting we could have a conversation about QT. And Tom, all of that with the real potential for that decision to be made going into recession.
In extra war in energy, I really wonder the disinflationary impulse there in a different economy that is Europe. I wonder if they're going to get a real earful of disinflation there.
Going to be super difficult, Tom, to get any disinflation from the energy story anytime soon.
I want to set up the conversation with John Farrell. John, don't move. And this is the 12-month trailing return on equities. Things maybe not as bad as the gloom that's out there. Standard & Poor's a negative 9%, down negative 10%. NASDAQ's a bear market, negative 20%. And John, you made an observation that a bull, like our next guest, is on the same page as a somewhat bear like Michael Hartnett. Discuss that polarity where they're on the same page.
On one issue, Tom, they want this central bank to get control of inflation and get out the way. I think most people have agreed for a long, long time that they don't want a Fed to have the presence it has in this market. TK, to have an 8-minute speech from a Federal Reserve chair to move markets by this much tells you how much this market is still dependent on the Federal Reserve. And I think what bears and bulls and every market participant alike agrees on, they want to get away from this world, Tom. They want to get away from this world.
We'll have to see. Kathy Jones publishing moments ago with Charles Schwab, and she says, well, you know, John, it wasn't the Gettysburg Address. John, did you have to memorize the Gettysburg Address in school? We didn't,
Tom. Different education, different country.
Oh. Okay.
We learned a little bit about Lincoln, Tom, but not too much. Just a little bit.
That's good. You wanted the Lincoln SVDB penny. That's the one you wanted. 19.
Well, you can teach me more on the commercial break. I can tell you that Evercore called that speech, not the Gettysburg Address, Tom, but they called it the anti-pivot speech. I like that. That's your cross-asset price action. Let's get you some movers. We can do that with Brahma this morning. Good morning, Lisa.
Good morning, John. You were talking about since the middle of June and where we are in the equity market. You talked about how the S&P is still 10% higher. The NASDAQ still 14% higher, has gained 14% since June 16th. How much do we get a reversal of that? I'm looking at some of the positioning, which is getting quite bearish in some of the big tech names. And you are seeing ahead of the market open today, the losses continuing from Friday when the NASDAQ was down almost 4%. Apple, Alphabet, and Microsoft all down more than 1%, led by Apple, 1.5% decline. How much is this the dual issue of not only the interest rates going up, removing some of their forward earnings that have been baked into their valuations, but also some of the semiconductor concerns that have been percolating and reiterated by every executive on earnings calls. I'm also watching the meme stocks, especially after Jeremy Siegel of Wharton came out and told Bloomberg at the end of last week that he sees a 10 to 15% allocation for meme stocks as being appropriate in portfolios. Not today. GameStop shares down more than 3%. Robinhood shares 2.4%. Coinbase, as tied to the whole crypto complex, Tom, down 3.4%. How much does rising interest rates really remove some of the froth that we saw, particularly from areas that already have been completely hammered, but perhaps have more to go?
No, we'll see here with futures deteriorating. Negative 33 is now negative 42 on SPX futures, right at the 4,000 level. Dow futures under 32,000, and the VIX, it's out now 2 full points, 27.54. We had Andrew Sliman on before with Morgan Stanley with decades of experience. We recapitulate now with John Stolfes, Chief Investment Strategist at OpCo Oppenheimer Asset Management. We're thrilled John on short notice could join this morning. John, explain why you're not selling, that phone call. OpCo gets it. Go to cash. Sell everything. Go to cash. I've never done that in my life. Why do I not want to go to cash this morning?
Well, Tom, thanks for having me on the show today. I have to say this. We think it's good that the Fed is doing what it's doing. It's on the case. It's going after inflation. It recognizes it's going to take longer, as we look at it today, for the Fed to put inflation in check. But the main thing is they're doing it. And what that will likely do is it'll kill off the speculative pockets like the memes or all those multiple currencies, multiple cyber currencies and exchanges that were created. It looked like that. At one point, I think we had more cyber currency vehicles than there were automobile companies at the beginning of the early 20th century.
Okay, so right now you see that it will just take out some of these pockets of froth, but will leave the rest of the market fresh to rally anew. What will be the trigger at a time when we still haven't seen quantitative tightening really take hold, and there still is more hiking to be done?
Well, Lisa, I think you said it. It's a matter of space on the timeline that needs to pass. With the Fed being active at addressing its benchmark rate and addressing the balance sheet issues. But I think the Fed is fairly determined here to put inflation in check, but I don't think it's aggressive in a negative sense. I think this is still the Ben Bernanke legacy Fed that's highly communicative. It's just that market participants, we believe, who on Friday were selling, it was a combination nervous investors, perma bears, as well as highly leveraged players, some of whom got burned in that huge rally that we've had from June 16th that brings up, double-digit returns for, I'm looking here, 5 sectors. From that point, they got hurt there, and now they're going short again.
So, John, I'm looking at your
to take profits without FOMO for them.
I'm looking right now at your S&P target for year end at 4,800. How much pain are you willing to take, and what's your hedge? Right? How do you sort of prepare for the possibility of being wrong?
Well, Lisa, you have to consider we don't live and die by a target on the S&P 500. That is almost a game that is played by the media and the strategists. It's a serious game because it talks about the direction for the Fed and how high we think it can go. But we're widely diversified across large caps, mid caps, small caps. We're growthier value and garpier growth right now. Dividend stocks, and on a relative basis, we're doing quite well in the portfolios we manage under that premise. So we've got to say there's a good chance that we could see 4,800 if we go back and see, a rally off of this challenge to the rally. And it is likely, if you look at history, when we publish regularly the maximum drawdown figures for the markets, 2 pages now, going all the way back into the 70s.
Yeah.
Stocks can actually go up even as interest rates rise and as there is concern over inflation. I got into this business in 1983, so I've been through a bunch of Fed fund hike cycles. In the beginning, it's always rough. The naysayers always say the Fed is going to fail. But I recall that the S&P 500 was somewhere between 120 and 160. That was the level it was at when I got into the business. And on Friday, with all the drama around the selling that day, it closed at 4,057. So I think monetary policy can be effective and has been proven to be so, even though it can be wrong and have to make various points.
And John, it's very important to note that Stolfus is so ancient that the Dow was 1,258 points in 1983.
Hey, John, can you promise me one thing? That if we get to 4,800 year end, you still get to call this a media game as something you don't care about. We'll see, right?
Celebrate. You can't
right.
Celebrate small victories.
Hey, John, come on. Every single one of you puts out a year ahead outlook, and at the top, there it is. It's the price target. It's a media game. John Stolfus, thank you, buddy. It's always great to catch up of Oppenheimer Asset Management on the year ahead. You need the bullish view because right now, everyone's looking at this, and I think a lot of people are thinking the same thing. What's there to be optimistic about here?
Well,
you've got a Federal Reserve that's telling you they're going to hike into weakness. We've got the adjustment on rates already. You can see it at something like 345 on a 2-year in America. And Mike Wilson's lining up to tell you, it's pretty obvious what happens next, isn't it? Earnings get smacked around. If the central banks, both the Fed and the ECB, are telling you, Tom, we're going to hammer growth, and growth's going to get hammered, and we're going to keep on hiking because we want to get inflation down. That's a difficult moment to feel like, hey, let's get long.
What is similar here, and you mentioned it earlier, John, is both the bears and the bulls are looking at corporate performance, earnings, margins, revenues. Will revenues be dampened by slowdown, et cetera? And the answer is the bulls fall back on one cardinal rule. Corporations, in every case, adapt and adapt rapidly. That will be interesting to see, particularly as an aside in retail with the holidays coming up.
And that's what supports the Stolfus camp, Lisa, that earnings have been resilient. Can you keep repeating that act through the next couple of quarters, given what this central bank's about to do?
Especially because talking about holiday time and retailers, I was looking at a number of surveys that talk to people spending a lot less on goods during this holiday season. So some of the concerns that keep percolating out from some of the retailers. Also, what does the strong dollar do, John? And I do wonder, given we have not talked that much about this and we're seeing the dollar at the strongest levels going back to 2002, how does that really affect some of the multinationals?
Do you think that's the next note from the investment bank over at JP Morgan? Year-end targets are a media game.
Well, that could be one explanation. We could discuss what he could potentially come out to be bullish.
So it's the media, isn't it? That drives me nuts.
Well, it's a media game, but it's played to the media by a lot of investment banks.
Futures down 0.9% on the S&P, on the Nasdaq 100, down 1 full percentage point. From New York City, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Today's scheduled test flight of NASA's new moon rocket could be delayed. Fuel leaks and a possible crack were discovered during final liftoff preparations. The space agency stopped and started the fueling of the rocket multiple times. It's set to carry 3 test dummies on the 6-week mission. Senator Elizabeth Warren has taken aim at the Federal Reserve's plan to fight inflation. She told CNN she's worried the central bank will tip the economy into recession. Warren said there's something worse than high prices and a strong economy, and that's high prices and millions of people out of work. If an Iranian nuclear deal is reached, Tehran may be able to put millions of barrels of oil on the market almost immediately. It's estimated that Iran has up to 93 million barrels of crude stored on ships in the Persian Gulf, off Singapore and near China. A nuclear deal would most likely lead to Iran being allowed to sell oil globally again. And in California, Governor Gavin Newsom has introduced a bill to keep the state's last nuclear plant open. Newsom argues that keeping PG&E's Diablo Canyon plant operating past its planned closure in 2025 is needed as the state transitions away from fossil fuels. Still, Newsom's fellow Democrats in the legislature are skeptical. Honda and South Korean battery maker LG Energy Solutions will spend $4.4 billion to build a battery factory in the U.S. The Japanese car maker wants to phase out fossil fuel vehicles by 2040. The location of the plant hasn't been decided. Bloomberg reported in June that Ohio is a front runner. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ruchika Gupta. This is Bloomberg.
China's appetite for energy is enormous. The country consumes about a quarter of the world's energy supply, 35% more than the US annually. Its energy needs have more than tripled since the year 2000. That consumption has helped to fuel astonishing growth, but it's come at a cost.
China is the world's largest greenhouse gas emitter. There is no way to tackle climate change unless China reduces its emissions to net zero.
The country's reliance on fossil fuels is also a hindrance to its own growth and the well-being of its citizens.
China is not energy secure. It has a massive import bill for things like oil and gas. It has a long-standing pollution problem, and it is also prone to outages that severely hamper industry.
All this has led the world's biggest polluter to take steps towards a radical transformation.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
In a $7 trillion industry, there's a lot of ground to cover.
Prepare for an economic hurricane.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
think we need to move, and we need to move methodically toward a clearly restrictive stance, which we're doing. And then, in my view, then we either pause, depending on the data. We're going to have to see how this plays out. We get to above 3.4 by year end, or at or above 3.4, and then we see.
Patrick Harker of the Philadelphia Fed going into the weekend on Friday from Jackson Hole. Live from New York City this morning. Good morning with Tom Key and Lisa Abramovitz. I'm Jonathan Ferro. The Jackson Hole Chair Power fallout continues. We're down 0.9 on the S&P. On the Nasdaq 100, down more than 1 percentage point, and yields are higher right the way through the curve. 2s out to 10s. Your 10-year up 7 basis points to 3.11%. On a 2-year up 5 basis points, just short of 245 right now. Tom, a little bit earlier, just short of 350. Came very close at about 348.
Any number of data points to touch on. How about Bitcoin under 20,000? That gets my attention, 19.796. Haven't done anything on that. We'll see. The crypto show tomorrow, I believe. They're going to schedule it even with BitDog under 20,000. Right now, as we look to China, a chart on China. Here's Kriti Gupta.
Yeah, we got to talk about the ripple effects of Jackson Hole and Chairman Powell's extremely hawkish comments. Well, those ripple effects went around the world, specifically to China, where you are looking at a Chinese yuan that was fixed at 6.9. It now has a sight set on that key 7 level. It's an important intermediate step to 7. For my chart of the day here, we're looking at the difference between the PBOC yuan fixing and the average estimate in Bloomberg surveys. For our radio audience, I'm going to give you some numbers here to really visualize what I'm trying to show you. The difference on an average day in the last 6 months or so is about 25 pips, so basically going out to the 4th decimal place. In the last 4 days, that has gone as high as negative 120 pips. So it really shows you that this is a market that has been consistently surprised by what the PBOC is doing as it tries to really stabilize its currency and prevent it from that weakening. The ripple effects of that, Tom, go to the Japanese yen, go to the Korean won. Ultimately, as you start to see the 2 largest economies diverge in their monetary policy, this is going to become a trade story for a lot of these export nations.
Kriti Gupta, thank you so much. There is a nuance of currency, of depreciation and devaluation. A depreciation is assumed with a floating rate currency, and a devaluation with a more and traditional fixed rate currency. China is somewhere in the middle. What we know for certain is there's been a 14% depreciation or devaluation, I'm going to call it, in the renminbi, that going back to 2014. Enda Curran is living this in China and joins us right now, our chief Asia economics correspondent. Is the system there, Enda, normal enough where Beijing cares about Chinese devaluation, or is it so removed within a totalitarian regime that it's not normal economics?
It very much cares what the exchange rate does, Tom. Remember a few years ago in 2015, they allowed the market more room to move the yuan around a little bit within a range. Of course, all the fundamentals at the moment suggest China's currency should be weaker. The authorities have allowed that to some extent, but now what's happening is that they are coming in and making sure that they are putting a floor on it for stability purposes, because on the one hand, they obviously don't want to import inflation. The PBOC has said, although China doesn't have a real broad-based inflation problem at the moment, they certainly don't want to start importing it via commodity prices. And on the other hand, of course, it's all about financial stability. They don't want to accelerate outflows out of China's bond and securities markets. That's already been happening at a fairly rapid clip. And then to the point that was just made, the yuan is a regional anchor. Ever since the Asia crisis in 1997, when they chose not to devalue, which was seen as a very important decision at the time, stability in China's yuan does help stability among its key trading partners in the region as well. And that certainly is among the factors as to why China is thought to be keeping it somewhat where it is at the moment.
So this is really complicated, Enda, especially because we've just seen a decades-long monetary regime flipped on its head in every which way, including the desire for a weaker currency to increase exports. Now a desire for a stronger currency so that you don't import that much inflation. How is this going to play out when it starts to affect the trade situation? In other words, stronger yuan, perhaps less trade, less exports from China. At what point does that become a conflict?
Yeah, so this is undoubtedly the big question, Lisa. Later in the year, if exports are softening, will the authorities then tolerate the yuan where it is, or will they allow it to weaken? This is a big question, I think. The real test will come later in the year when trade is expected to slow down. Trade has been one of the pillars of China's recovery over the last few years, and that's expected to come off. And if that does start to happen, then you might see the authorities under pressure to let the yuan weaken as well. There's no doubt about it. So I think trade is a big part of that story.
Well, when we talk about trade, we also were talking last week about some of the power outages, particularly in Sichuan, and how they were slowing down some of the manufacturing output. That's coming back online. However, you are seeing around the rest of the nation, lockdowns are re-ensuing in places, even in like Beijing, certain crackdowns as they try to keep COVID under control. At what point does this have a permanent effect on the factory to the world reputation of China and really lead to structural changes of a lot of international companies?
Well, it's another day, more announcements of restrictions and lockdowns, Lisa. Like you just mentioned, and the state press were out today saying, look, the government is sticking with this COVID zero policy, dynamic COVID zero. Everybody else has to stick with it too. Tianjin under more restrictions and testing. Shenzhen, next door to Hong Kong here, the world's biggest wholesale electricity distribution markets under restrictions and a kind of a lockdown in there at the moment. Economists are downgrading their forecasts now for China, median forecast of 3.5% for the year. Real estate's in a slump. We've just mentioned the impact from extreme weather. Exports expected to slow down. And of course, ongoing COVID zero. You might suggest something will have to pivot at some point soon, but at least in COVID zero, there's no hint of a turn on that at all. As I mentioned, the state media made clear this morning that there's no room for turning on that. Congress is coming up in November. It's hard to imagine China would really want to allow a public health disaster ahead of that.
Enda, thank you. The brilliant Enda Karen late into the evening in Hong Kong. Enda mentioned the quarterly survey of economists that we conduct here at Bloomberg on growth going forward for a range of countries, including China. Those expectations, projections have been lowered all the way out to the third quarter of next year. Lisa, the number that Enda mentioned, 3.5%, that's the median. That's down from 3.9, and we've mentioned the forecast from Goldman and Nomura a few times, but just to remind everyone, Goldman's something like 3% GDP growth this year. Nomura has a two-handle. I think it was 2.8% for GDP in China this year.
Wasn't it Billy from Milken who came on and said that nobody on Wall Street, or most of the analysts, are not going to lower it below 3%, but it is a political move more than it is a fundamental economic move because they don't want to be seen as so bearish. The question is, when does it get back above that level? And that's also what's getting to your point, being lowered progressively throughout the years. This is really concerning, not only for China, but also for global growth projections.
It's the old take on Wall Street, Tom, when it comes to Chinese data, that if it's good, it probably isn't, and if it's bad, it must be really bad.
Yeah,
and right now, that data's not good.
Well, it's not good right now, but as Leland said, maybe it's a lot more accurate than we care to believe. I don't know, but I do say, John, the veracity of the data, I just think top to bottom is suspect. And you see that with, stuff that doesn't even make the headlines of where a given operation is being bailed out by a company you and I have never heard of, which clearly is related to the government.
Tom, things are so complex right now that these bigger stories are sort of out there on the periphery and don't even make it into the headlines.
They do. This is true. And I think that what we have to fall back on is the data of Bloomberg surveillance. Was that good?
That's great. Futures down. This is Bloomberg.
Wound up from cold tank.
Anticipate that you will have regulations clarifying what the SEC is going to do on cryptocurrencies and related kinds of things in the near future?
It's pretty clear that many of these tokens may be securities. What we've asked the trading platforms, the lending platforms, the other various venues to come in, to work with us, to get registered under the securities laws, because if a platform has 50 or some of them 500 tokens on their platform, probabilities are they're not all non-securities.
Now, there's another issue that has arisen, which is called gamification, which is to say people are making a game out of trying to buy stocks. Are you worried about this phenomenon?
We live in the 2020s in a new digital age where applications on our phones can use massive amount of data and then predict our behavior. What do we do when the digital algorithms are maximizing for the company's revenues rather than our returns? And so we're trying to think that through. It's not just gamification, it's a little bit more than that. It's whether there's a conflict between the app and our investment returns.
Lots happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights
We think that's the next secular shift.
from businesses most influential and instrumental.
Yes, it's about renewables.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio. However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg. No one covers the world like Bloomberg.
We have to get interest rates higher and bring inflation back to our targets.
Spare capacity is becoming scarce. We are running on thin ice.
No one deliberately wants to go into battle, but we sleepwalk into conflict.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Somehow we have to find a manageable pathway down to a lower level of inflation.
I think we have seen the peak. I think it is going to moderate, and I think we can all hopefully look forward to that.
The people that are saving don't need the money. The people that pay the interest rate can't afford it.
We know that a lot of the supply side constraints are outside of the purview and the mandate of the Fed, and that's where the problem emerges.
Given where spreads are and given the amount of contraction that we've seen, we definitely think that there could be trouble ahead.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. The market move continues off of Friday's Dow 1,000 points, a VIX out 2 points earlier. John Farrow, it's not just stocks, bonds, currencies, oil, they move.
Take your pick, Tom. Foreign exchange earlier this morning, the dollar the strongest, going all the way back to 2002. Earlier this morning, the two-year yield the highest since 2007, taking off the June 14th highs. Tom, we take them out. Back around them right now at about 345. Became very close, just 2 basis points away from having a little look at 350.
And what's interesting here, John, is with the calendar. We've got to get out, and what's so important is out is not to the next Jerome Powell press conference. Out is to September 8th, because Europe matters to America.
The ECB, they've both got one priority, to hike rates to get inflation down. And Tom, they're willing to tolerate a slowdown in the economy. How much are they willing to tolerate that? That was the big effort over the weekend. We've got one priority, get inflation down. And I think they really wanted to communicate, Tom, that the hurdle, the bar to pivot, the bar to pause is a lot higher than you think it is.
1939, 12. John, how do you raise rates into a war?
How do you raise rates into a recession? That's what the ECB is about to do, Tom, in the minds of many.
Lisa, you took the Gulf Stream back. What'd you read about this weekend that matters to you after Jackson Hole?
I think the big discrepancy right now is people who believe that this economy can withstand a 4% interest rate for a longer period of time, for 2-3 years. And that, I think, is really the feeling right now between those. And I wonder how much John Stoltzfus represents really a more bullish tilt of, yes, these companies can sustain it, and perhaps some of the game stocks and some of the ultimate corners of froth will get beaten out, but not necessarily the mainstays of the economy. And then you have others that say, no, this is going to be painful. There is going to be a downturn, and that is going to be difficult for companies to stomach, regardless of who they are.
Not that I can remember because I was frozen, the hot tang not helping me, but John, Mr. Bullard says front load. What are we front loading into if we see a sustained level for 1 year, 2 years, 3 years, is a number of people talk about?
Tom, it's into the unknown for 2023 and beyond. They're focused on one thing, and I think Jim Bullard really tried to push this one home. We asked him about the longer-term neutral, that dot at the end of the dot plot. Tom, he doesn't want to go there, doesn't even want to talk about it.
Right.
He doesn't even think there's much value in those kind of projections. We have to deal with what's in front of us right now, CPI 8.5%, and rates in his mind and many on the committee that remain too low.
Below parity on the euro. Let's jump into the data, John. I'm going to look at dollar, BBDXY, which is a really good set of math on EM currencies as well. Truly out to record dollar strength this morning. John, sterling, 117 exactly. That must be because Harry Kane missed that penalty shot. Euro 0.9996. John?
Hard to keep up with the price action, Tom. Some negative follow-through from Friday into Monday. Equity futures lower, down by 0.9%. Negative on the NASDAQ by 1.2%. The story of the equity market, lower, lower, much lower. Of the bond market, yields higher, higher, much higher. Just short of 3.1% right now. We faded a little bit from the highs of this morning. Yields still higher by 6 basis points or so. Euro's a fascinating one. I just do not know what to do with euro dollar. Euro dollar 99.95.
Yeah.
We've got yields on the periphery breaking out this morning. The ECB reportedly set to discuss QT, set to discuss a 75 basis point rate hike, set to hike rates into a recession. Even if they see one, they're willing to keep on going.
Right.
Does that mean you buy the currency, Tom, or do you sell it?
Very quickly here, John, what's interesting is the diffusement of a currency, not against a major pair like euro dollar, but the summation of the dynamics of euro Czech, euro zloty, and on and on and on. All of those micro movements around euro will matter here.
So the Czechs, Tom, have the rotating presidency of the European Council this year.
Right.
And they're trying to call a get-together of the energy crisis, Tom. The energy crisis is not going away this year. And, Tom, I would suggest that what we heard over the weekend from the SNB governor, Thomas Jordan, is that we might have to face the consequences of higher inflation for a lot longer, maybe several years. That's a new conversation, Tom, in the last couple of months.
Yes.
Not just on the energy front, but on the inflation front. This might not be a one-year story.
Right.
It might be a multi-year story.
Well, let's get to that right now. She's out of Georgetown Finance and enjoyed Harry's Italian Pizza Bar for 5 years at the New York Fed. That makes her qualified to talk about rates. Megan Swiber joins us with the Bank of America Director of U.S. Rate Strategy. Where's your x-axis? Not the y-axis, the level game and all that. Where are you on the continuum of U.S. rate strategy?
So, Tom, what I think we need to take in mind here is that Powell delivered this very clear message that the Fed is going to do what it takes to get inflation down, even if that means pain for businesses and households. In our view, we are expecting a mild recession to occur later this year into next year. And ultimately, that's what the Fed needs to do to basically get inflation back down.
You think back down to what, though, Megan? Do we get back down to 2% with a mild recession?
Yeah, John, I think that the Fed needs to ultimately target that 2% level. And as we heard Powell discuss last week, right, they're not looking at moving the inflation target. They're going to do whatever it takes to accomplish that. I think that the Fed will likely keep hiking until they really see progress being made here. And as we heard last week as well, they're not looking at even just the recent cooling in inflation as anywhere near a victory just yet.
So, Megan, with that in mind, and as we start to think more about the appropriate time horizon to guide inflation back towards target, what does that mean for how you push that view right the way through the curve, 2s out to 10s?
Yeah, John. So what we see right now is the Fed topping out between 3.5, 3.75 or so. That's still going to mean that the 2-year has more room to go higher. But at the back end of the curve, we also need to see the markets price this risk of recession, of the Fed ultimately needing to move rates back down at some point once they have reached their expected inflation rate, once they have reached target, and they have moved unemployment well above those longer run averages. Ultimately, we think that the Fed will probably deliver cuts beginning in the second half of next year. But really, for now, the market is still very focused on where this terminal rate is necessarily going to be.
Megan, this is rather shocking because basically Fed Chair Jay Powell said, in so many words, we're not going to cut rates. Stop thinking about that. We're going to hold rates high for a very long time, or for as long as it takes before they see the whites of disinflation's eyes. How much can you have this conviction around the idea of rate cuts, given the conviction of Fed speak against that?
Yeah, Lisa, and you know, part of why Powell's been pushing back on this, and other members of the committee have as well, is because they're forecasting this soft landing. If you look at the SEP dot plot from June, what you see is that they're able to hold rates at that 4% or so level well through 2024. But that's because it comes with only a very modest move higher in the unemployment rate. That is a very, very optimistic picture, and thinking that that's all it's going to take to get inflation back down to target.
Okay, but Megan, and I apologize for cutting you off, but if this is the case, if we see a very hard landing, a steep downturn, which is what you're saying, that will lead to rate cuts by the second half of next year, does that mean that inflation will also be back down, or will this basically be the Fed blinking and saying, in the face of weakness, we're not going to keep rates where they are?
Right, Lisa. So what we're envisioning is that this mild recession does what's needed to cause inflation to move back down to target. You have to think of the composition of the inflation basket here, right? On one hand, we're seeing the improvement in supply chains help put downward pressure on goods, but really it's wage pressures that are keeping services elevated. And in order to engineer that cooling in services, we need to see the unemployment rate move higher. And ultimately, we think that that will bring inflation back down towards target. That doesn't mean, though, that the Fed can't cut with inflation modestly above target. That's because the Fed's going to get to a terminal rate that's still very aggressive, something close to about 4% or so, right? And that's well above the Fed's longer run expectation of where that neutral rate is. So they could still have a modestly aggressive policy stance with the Fed funds rate, say, at 3% instead of 4%.
So, Megan, just to be clear and put a bow on it all, you're not questioning the reaction function of the Fed. You're not doubting that. You're questioning the forecasts.
Yes, John, that's exactly right. So what we see is that the Fed's expecting this very soft landing. We think that that's going to be very hard for them to achieve. What we generally see is that most Fed hiking cycles end with something like a recession. And that's what we're expecting this time as well.
Megan Swiber, awesome. Just a final word. You said there was some upside here on a 2-year, 350 almost this morning. Can you just put a number on where you think that upside is?
Oh, there you go. Getting in trouble.
We see it at around probably 275 or
so. Oh, come on. You can't go to 4% on the way to 275?
375, right?
Or excuse me, the Fed funds rate, we see that as around 375.
And the 2-year as well?
Yes, they could probably get up to 3.5% or so.
Okay, good.
Yes.
Very close this morning. Megan Swiber of B of A. Megan, thank you. Good to go through that. There's a very important difference between questioning the reaction function or even doubting the reaction function that was communicated going into the weekend by this Fed and Lisa, and just questioning the forecast. And Bank of America are just questioning the forecast, as everyone is free to do so.
Well, and perhaps the market is largely doing that as well, because you're not seeing a huge reversal, although you are seeing some. So at what point is this the Fed able to get ahead of a narrative while also being behind on the projections of what the economic outlook will look like?
And that's exactly what Peter Scheer of Academy was doing earlier this morning as well. He thinks that weakness is right here, right now. We've already made the turn.
Yeah, although, again, especially with balance sheet unwind, it's unclear how quickly they can pivot, even with rate cuts.
The future's down 1% on the S&P 500, on the NASDAQ 100, down about 1.23%. Live from New York City with Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Payroll's Friday, just around the corner. Only mentioned that a couple of times already this morning. More still to come on the labour market in America. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Rishika Gupta. Today's scheduled test flight of NASA's New Moon rocket could be delayed. Fuel leaks and a possible crack were discovered during final liftoff preparations. The space agency stopped and started the fueling of the rocket multiple times. It's set to carry 3 test dummies on the 6-week mission. U.S. Navy warships have sailed through the Taiwan Strait for the first time since House Speaker Nancy Pelosi's visit to the island. That trip strained relations between the U.S. and China and led to Chinese military exercises around Taiwan. The Navy says its ships were demonstrating the U.S. commitment to a free and open Indo-Pacific. And China is moving aggressively on COVID as a meeting of top Communist Party leaders approaches. Authorities are enforcing lockdown restrictions in areas around Beijing more intensively, and they'll mass test the port city of Tianjin. Elon Musk became the world's richest person in large part through his electric car company. Still, at an energy conference in Norway, Musk said he's not one to demonize fossil fuels.
I do think we actually need, and actually at this time, I think we actually need more oil and gas, not less. But simultaneously moving as fast as we can to a sustainable energy economy.
Musk spoke as Europe is grappling with its worst energy crisis in decades. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
To name a couple of your babies. I don't know if I'm asking you to choose amongst your children, but you know, some of the most recognizable buildings by you, of course, the Millennium Bridge, London City Hall, the Reichstag, and the Great Court British Museum. What was your favorite project to do?
The Reichstag does stand out because, first of all, it's an energy manifesto. So it transformed something that was dependent on fossil fuels. It uses all the technology to produce something which is essentially carbon neutral. And as a public building, that's a statement. It's a symbol of a city, it's a symbol of a nation. It incorporates works of art. It's recycling an existing building, which, as I mentioned earlier, is the ultimate in sustainability. If you can give a new life to a building, it also creates public space at the roof level. It is the most visited parliament in the world, so it puts the public above the politicians who are answerable to them. And that, of course, was made possible by the politicians. So it's a demonstration of democracy in action.
The difference between political gossip and policy intelligence. Bloomberg Government provides our clients with expert reporting, analysis, and public affairs tools that give you the edge in reaching policymakers on the Hill. When you're in the business of influence in Washington, information and connections are the currencies on which you rely. For knowledge you can act upon, the difference is Bloomberg Government.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Last month's jobs report caught everyone off guard.
This is quite a surprise. Oh my, as Dick Enberg would say.
That is a wow statistic.
That recession talk just got a freezing cold shower.
Today, the surveillance team brings you the crucial jobs data and expert analysis at terminal speed.
It's good news, bad news, good news.
They're walking that fine line.
We still have a large gap between jobs and workers, but at least we're moving in the right direction.
The market has 2023 wrong.
The August jobs report today on Bloomberg Television and Radio.
Inflation is extremely high, sort of unimaginable. The levels we're at were unimaginable 18 months ago. And so we have to get that under control. That's job one. That's our top priority.
That is job number one. That was Raphael Bostic, the Atlanta Fed president, speaking to us in Jackson Hole, Wyoming, just this past Friday from New York City this morning. Good morning, live on TV and radio with Tom Keene and Lisa Bramberts. I'm Jonathan Ferro. Futures lower 0.9% on the S&P 500. If you are just tuning in, we have a little bit of an equity market sell-off here, down by a little more than 1% on the Nasdaq 100. Yields higher by 5 or 6 basis points through much of this morning. Let's round this one up for you. Your yield on a 10-year 3.1%. The euro 99.87, showing just a little bit of strength, up by 0.2% on that currency pair. Going into the ECB next week on September 8th, with a 75 basis point rate hike on the table to discuss, the prospect of QT being discussed as well. Just want to mention payrolls this Friday, Tom. For those out there that missed that estimate, 300K is the estimate still. It's come up a little bit from the guide of last week as the numbers pour in, Tom. The number goes higher.
How do you have a recession with 300,000 units non-farm payroll? I don't get it.
Clearly, that's very difficult to call that a recession, Tom.
Yeah.
The question people ask, though, Tom, is whether the labour market is lagging, and you're already seeing the pain developing that's ultimately going to spill into the labour market sometime soon.
Bloomberg Surveillance has been committed to economics. We're really looking forward to giving the Jackson Hole treatment to Sintra when they come around again in Portugal. And at those efforts, there are academics. We avoid them like the plague. We do that for all sorts of reasons, but every once in a while we get lucky and lasso in one of them. At Jackson Hole this year, Francesco Bianchi of Johns Hopkins, ex-Duke, ex-Princeton, stopped traffic by speaking the word that no one wanted to speak, and that is fiscal economics. It's a 29-page paper loaded with math I don't understand, matrix algebra. We just can't do that on TV, but we can talk about the basics and the policy prescription out of this. You say there can be a monetary-led solution or a fiscal-led solution. Within MMT, does the Fed do a fiscal-led solution, or is that the part of Congress and the president?
So right now, I think the Fed is committed to bring inflation down. I guess the main point of our paper is to show that the Fed also needs cooperation from the fiscal authority. So we take an historical perspective and we look back at the 60s and 70s and provide an argument that there was a fiscal phenomenon, ultimately. It was dovish monetary policy, but combined with overspending and no commitment to that stability. And so now the question, the Fed is acting, is moving interest rates up. So our question in the paper is that if going forward, we will see the necessary fiscal adjustments to bring inflation down. That would be the fiscal solution to the problem.
What did you learn from Stephanie Kelton's MMT? This has been all the rage. The media loves to pick on it. There's a political polarity to that. You come from the neutrality of Europe, of Italy, Costanzo over in Portugal, and the rest of them. So you're the foreigner looking in at the debate of MMT. What have you learned about MMT in this crisis?
So I think what we learn I think all of us, what we learn is that fiscal policy can be extremely powerful. Fiscal policy arguably put a stop to the low interest rate environment. We were for 10 years at the zero lower bound. In fact, we risk of deflation. I think we tend to forget where we were 1 year ago. The Fed was genuinely concerned about deflation. We intervened very forcefully with fiscal policy, and that contributed to the solution. Of course, it caused a big jump in inflation, arguably because it compounded with some exogenous forces like the pandemic, of course, the supply chain problems, the Russian conflict. But ultimately, fiscal policy proved to be a very powerful mechanism. I think what we learn, on the other hand, is that this comes with a cost, and the cost is inflation. Now, it's always easy to do policy with the benefit of hindsight, but with the benefit of hindsight, probably we went a little bit overboard.
Well, Francesco, there's a really profound implication here. It's not just what the response was, it's the expectation in the consumer's mind that there will be more fiscal stimulus if there is another downturn, and that is what is going to lead to inflation expectations becoming unmoored. How much does that really crimp the ability of policymakers to either add fiscal stimulus in the face of a recession, mitigating some of the downturn, or B, going for the fiscal stimulus of the past few years and leading to inflation that's much higher than it has been in the past?
That's an excellent point. And in fact, what we emphasize is what really matters is long-run fiscal sustainability. So what we want is to be able to use these powerful mechanisms during recessions. But in order to do that, we need to guarantee that overall, in the long run, or at least in the medium run, we are on a stable path. So what that implies is essentially that when things are good, when we don't need to provide fiscal stimulus, we should refrain from doing that exactly to keep this ammunition to when we need it.
I got one quick question. I saw Richard Claret at Jackson Hole, and I want to go back to the core of your paper, which is DSGE. Richard Claret has worked with Gertler and the rest.
Right.
How can we trust this math? All the mathing smart guys like you are doing, has it been proven wrong given these shocks that we've seen?
So I don't think so. I think the math is just a way to formalize some ideas. So what we are discussing here, I think, is something that everybody can relate to.
Right.
People have had first ideas and then came the math. So the math is only a way to put order. And I don't think that DSG models or more in general macro models in themselves have failed. If anything, there are some risks that we forgot about.
Okay. And John, it's important. Oh, Lisa, good news. I just got it. The car to take you to the Abramowitz house to explain matrix algebra to Lisa's kids, it's waiting.
Francesco, thank you. Francesco Bianchi there. On fiscal policy and what it means for inflation expectations. Lisa, I wonder what that means for Europe as we get into this energy mess, and ultimately, we're all looking for fiscal policy to offset some of the pain.
Yeah, you've been talking about that. So if you're looking at an inflation problem, and Francesco's point is well taken, that additional fiscal support exacerbates this expectation that policymakers will jump to the solution, to the rescue in the face of trials and tribulations, it will allow inflation to go further up, even if it temporarily mitigates the pain of some of the higher gas prices.
I'm going to push against that, John, in that I think there's so many unknowns now and so much uncertainty. I really question the core mathematics of Gertler Claret and what we see from Professor Bianchi. The uncertainties out there and shocks to the system right now, off of a natural pandemic, are huge.
We'll keep this conversation going. Sam Stovall's going to join us, the Chief Investment Strategist over at CFRA. If you're just tuning in, where have you been? Your equity market's lower by 0.8% on the S&P. On the Nasdaq 100, down by a little more than 1%. We're fading a little bit here. We're off the lows on the equity market. We're off the highs in the bond market. Yields higher still by 5 or 6 basis points, but below where we were earlier this morning. On your 10-year, 3.0949%. And the euro showing a bit of strength. Back through parity. Euro dollar positive, 0.5%. From New York City, this is Bloomberg. Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Welcome to the world of DC. decentralized finance.
I'm going to take a look right here at regulation.
We are seeing digital currencies under some pressure.
Bloomberg's covering all things crypto. The people.
I want to have some of my money outside of the sovereign.
The transactions.
It all comes down to the details here.
And the technology.
How does that affect disruptors like you?
What happens to everything that you're investing in when the last Bitcoin is mined?
Bloomberg Crypto, Tuesdays.
You do not get stronger that moment that you're lifting the barbell. You get stronger as your body is making repairs, making recovery. Recovery is when and how you get fitter, faster, stronger.
Recovery technology includes everything from massage guns and foam rollers to compression boots, hyperbaric chambers, cryo chambers, infrared saunas, and even infrared pajamas. And athletes are partnering to become investors to take those products mainstream.
When you look at tech in sports right now, it's completely innovating the way training's going, completely changing the way recovery's going. I think sky's the limit as far as where it can go.
But while some of these products can feel amazing, it can be difficult to differentiate between what really helps the body and what just tricks the mind.
Every time you're chasing the latest, greatest, newest tool, you're probably chasing a mirage.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Is moving both Citadel and Citadel Securities to Miami. The scoop was broken by Bloomberg's Amanda Gordon.
Live from New York, this is Bloomberg Surveillance on TV and radio. I have to say, as the session grows a little bit older, things get a little bit better for the equity market bulls. Yeah. We're lower now by 0.8% on the S&P. The Nasdaq off the lows, down not even 1 full percentage point now on the Nasdaq 100. Very close. Yields off the highs as well, up 4 or 5 basis points at the moment to 3.09%. The euro a bit stronger, dollar a bit weaker as well. Euro dollar back through parity, a break to the upside, 100.16, positive 0.5%. Setting you up for payrolls Friday. The latest estimate is 300K in our survey. This is what Citi's got to say. Andrew Hollenhorst publishing moments ago. Assuming a decent jobs report, he says the following: whether the Fed hikes 50 or 75 will depend on September 13th. Quote, used car prices will likely weigh on the core reading, but strong advances in shelter and other services keeps us expecting a 75 basis point increase. I have to say, Tom, whether it's 50 or 75, I think the message from Powell is bigger than that, away from September. It's we've got a job to do, we'll do more work. It would be premature to back away anytime soon, and even if we get the weakness, we're going to keep on hiking.
Totally agree. Neil Ferguson wasn't a Jackson Hole, John. Let's do a Ferguson counterfactual. Why did the market move right away when Powell spoke? Why did it take 2, 3, 4 hours for boom?
For boom, Tom?
Down 1,000.
I don't know. You want me to explain things tick by tick? I can't help you.
I was just surprised we didn't see the reaction right away, frankly.
We got it in the end, didn't we? Yeah. Getting it again this morning.
Yeah, it follows through this morning. Futures negative 32. The VIX was out 2 big figures, 27.30. I'm not going to be gloomy and say we're on the VIX 30 watch. We're not there yet. We are lining up people with equity experience. That would be Sam Stovall, Chief Investment Strategist at CFRA, and we really thank him this morning on short Dow down 1,000-point notice. Sam, as you think to a Monday morning, as you write to September, what is your lead theme given the volatility?
I think the lead theme is that we end up retesting the June 16th low. But right now, our belief is that we do not set a lower low. So right now, increased volatility, it will be a September to remember. but I think we will get through this okay.
The hallmark of your father's work and your work and CFRA's work is corporate analysis. Explain your confidence in margin resiliency at corporations to the end of the year and into next year.
Well, you're bringing up a good point, because here we are just beginning the final month of the third quarter. Earnings estimates are expected to be up 4.3% for this quarter. However, 6 of the 11 sectors in the S&P are predicted to show some declines. But when we look at the profit margins, they've actually held up exceptionally well. In the second quarter, profit margins were expected to be down 5.3%, and they were pretty much in line. So we are expected to see some continued whittling in profit margins, primarily as inflation remains fairly sticky, as price hikes for inputs, et cetera, are felt by corporations. So the real question is, what kind of damage will be done to earnings and profit margins as the year progresses?
Well, and the year progresses, a key aspect of that is how the Fed responds and how much the Fed hikes rates, how much they tighten policy, how much they confirm and act on the message that Jay Powell was sending on Friday. How much does that shape your narrative? How much does that shape what you are willing to buy and how bullish you can get?
Well, right now we're expecting a 50 basis point increase at September, but obviously knowing that could be a coin toss depending on the data that comes out between now and then. Maybe it gets revised to 75. But right now it's a 50 estimate for September, 25 for the remaining 2 FOMC meetings this year. But important is that the Fed will keep a higher Fed funds rate through 2023 and possibly early into 24, as they want to make sure that they can strangle inflation. So I would tend to say that right now, momentum models are continuing to point to inflation hedge sectors like energy and materials, but also to the defensive staples and utilities at the expense of the more growth areas of communication services, consumer discretionary, and tech.
So, Sam, you're buying energy equities. Is that what I'm hearing from you? This is an interesting call, given what we're hearing out of Goldman right now.
Well, I think you have to look to the energy stocks, not give up on them for a couple of reasons. One, they still offer a very nice dividend yield, but probably more important is if you look to the absolute PE ratio versus long-term history, the S&P 500 energy sector is trading at a more than 50% discount. When you look to a relative PE ratio, the numbers look pretty much the same. So it ends up, unless you think that energy is going to just stop being of interest to investors, I still think there's a long-term opportunity.
The two schools of thought here. On one hand, you have the people who say energy structurally is going to be a winner just longer term based on what the supply and demand would say. On the other side, if you believe in a recession, you believe that the equity markets will penalize oil. And that's definitely what we've seen, at least over the past few weeks. Does that matter to you, the idea that the Fed has to materially slow the economy and that it's already slowing naturally because of inflation, and that will be bad for demand and bad for energy prices?
I think that the closer we get to a recession, and if you look going back to World War II, every time the year-on-year percent change in headline CPI exceeded 6.5%, we had both a bear market and a recession. And while the bear markets ended up being deeper on average when it was accompanied by recession, not all of those bear markets ended up being 30% plus. So ditto for the depth of the recession, if there is one. Our economists are basically saying that it would end up being fairly shallow, and as a result, probably not have the kind of disruptive demand aspect toward energy as one might expect.
Sam Stovall, there was a chart out this weekend which reminded me of your legendary father and, quite frankly, John Maggie of the 1940s. And it was a collapse of RCA out of 1929. Every generation has an RCA. Are we too arrogant that we feel this time is different?
Oh, no. I mean, whether it's Penn Central, whether it's Drexel Burnham, et cetera, there will be, or Bear Stearns back in 2008, there usually is some sort of a collapse that ends up signaling a lap bell, if you will, to this bear market. We have yet to see that, and I think that it's something that we probably will end up seeing. Maybe it's an international bank. Maybe who knows what kind of company it might be, or something a little closer to the 21st century where it's something that is more crypto related. But we have yet to see that. You're absolutely right.
Yeah, we're not talking crypto this morning, Sam. It's under 20,000. We're going to ignore that. Sam Stovall, speak to the institutional audience. Give us an update on the efficacy of a 60-40 portfolio.
Well, I think 60-40 is still something for investors to be focusing on. Yes, this is a rare situation in which you had bonds down 27%, you had the S&P off 24%, but still bonds offer ballast to an overall portfolio. And go back in years, every time that we did have a sharp sell-off in the bond market one year, we ended up with double-digit returns the